This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. We are coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Sonia, and Reema is with us here on the program. Guys, hi, good morning.
Hi, good morning, Prashant. Good morning.
Hi, good morning. Markets are fizzling, temperatures are sizzling. That's the only thing I can say. You know, weather gods are really playing havoc, right? In Dubai or here.
Absolutely. I mean, it's so hot in Bombay. It's unbearable. But I guess what's bearable is we got that midweek holiday. So we got some time to perhaps just, cool off at home. But it's hot in the market as well. I mean, there is some amount of pressure and there's so many cues to watch out for.
I know the weather, I think it's 30, but feels like 40 because of the humidity.
It's 39.7, 6.5 degrees higher than average. It feels like not 30.
All right, well, I was under the nice, benign impression that, it's not as hot as we're feeling, but it is. And it feels even hotter then. So let's just quickly rewind the clock. And we've got to sort of take into account 2 days of market action, global market action. Because that's what sort of we missed because of the holiday yesterday. So, the last 2-day change will come up on the S&P and the NASDAQ. The S&P is down about 0.75%. The NASDAQ was down about 1.25%. This is over last 2 sessions, Tuesday and Wednesday. Now, the big story, the big headline, of course, has been Fed Chair Powell essentially completely not a 360-degree turn, but a fairly aggressive turn about what he thought he'd be able to do, which is lower interest rates. So Fed Chair Powell, he doubted the progress that they've been making in the US on inflation. And he essentially said, if I had to, we'll put out a quote later as well, but he basically said that core PCE inflation, which is due next week, this is for the month of March, if it remains stuck at 2.8%, then that would be reason to delay cuts further. And I think, this is quite something. The first time Fed sounded dovish was when the US 10-year hit 5%. That was fall last year. And then financial conditions eased. And throughout the last many months, we've been hearing from Powell that, the path forward is lower and it's coming. That's essentially what the market has been made to believe. But in a way, Powell sort of marking himself to the market because we've had 3 data points, actually 6 in total. 3 non-farm payrolls number, jobs data, which have been blowout numbers, strong numbers, and 3 CPI numbers, which have been above expectations. And that's basically what's caused this. Now, the 10-year in the US, it hit 4.66%. That was the high day before yesterday. And then it slipped. So basically, an 8 basis point rally on yields on Tuesday. And then yesterday, last night, an 8 basis point slip. We left off at 4.59. Pretty unchanged from our perspective. The dollar index, it slipped a little bit. So we're just under 106, 105.92 is where the dollar index is now trading at as well. Now, oil prices, they slipped as well. 3% in the last 2 trading sessions. We are at about 87.40. All right. I mean, oil was looking like it's going to have a runaway move because of geopolitics, etc. But I think the lack of any new geopolitical news is being interpreted as good news as far as commodity markets are concerned, right? Because, there is chatter, there are comments from this side, that side, but there is nothing new which will move the story forward in terms of how the retaliation, which Israel has said it's got no option but to, will come, in what measure and when exactly. Now, overnight, we also kind of heard some bit on tariffs. This is US-China. It's an election year in the US, elections in November, but we're already starting to hear, both sides, Democrats and Republicans saying, they're both united on one thing, that you got to tariff China more. So Biden last night, essentially, President Biden called to triple the tariff rate on Chinese steel and aluminum products. That's one. Trump, by the way, weeks earlier has already said that if he's elected back to power for his second term, he'll impose a flat 60% tariff on all Chinese imports. Of course, it looks like a starting salvo more than anything else in terms of negotiations, etc. But both are united that tariffs will go up. And we're again perhaps going to be talking about, irrespective of who comes into the White House, tariff wars, right? Trade wars in that sense, what we were talking about earlier. Now, where does all of this leave us in terms of the market here? I think we are still not out of the woods. I think that much is very clear. But can we get a decent rebound from where we left off on Tuesday? I think it's possible. So the reason I say that is because we've completed a 61.8% retracement of the full rally. That was a 1,000-point up move, 21,710 to 22,775, almost exactly 1,000 points. And on Friday, we got to 22,117, and then we had a nice, decent bounce. Not a big one, but we left off, about 30, 40 odd points higher from that level. Can we get a bounce from here? Fingers crossed. Gap area, where's the resistance? If we do get that bounce, it's around the 22,240 to 22,500. It's a big gap area, and that, I think, in that zone, the market, the Nifty, will find some resistance. The Bank Nifty on Tuesday made a low at the 40-day. It was almost exactly to the point. The low was the 40-day exponential moving average, and then we saw a bounce which was sharp. And here for the Nifty Bank, supports come in at 47,472 and 47,314. These are nothing but the 20-day, which the Nifty Bank closed above, and then the 40-day, which was the low, which corresponded with the low on the Bank Nifty on Tuesday's session. The Gift Nifty will come up on your screen. I think it's going to be an interesting next couple of sessions. It's absolutely flat this morning in terms of the open, at least right now. Sonia.
Oh, absolutely. And, I think a lot of the damage has been done, right, in the last couple of days. I mean, the Nifty is down almost for 3 days in a row now. And if you look at it, there was large selling that you've seen from foreign investors as well. So FII sold, about 4,468 crores in a single day on Tuesday, and put together in 3 trading sessions, FIs have sold 15,000 crores. So money is being pulled out from the foreign investors. In fact, from the April 10th high, the Nifty has already lost about 2.6%. So yes, we are in some sort of corrective phase. How long this phase will last, no one can tell, no one can predict it. The best thing to do is just to sort of step back and, wait for this phase to sort of settle. As Sudarshan Sukhani was also telling us a couple of days ago, wait for some sort of base formation before taking the next call in the market. If you look at what happened in the US markets as well, 4 straight days of selling. The positive is that Brent crude has fallen 3% overnight. Brent is now at $87 a barrel, little above that. The market seems to have dismissed the risk of a wider war between Israel and Iran for now. And, the fact that could disrupt supplies further. So that risk has been dismissed, and hence Brent crude is back at $87 a barrel. A couple of things to watch out for. It's a big day of earnings. You have Infosys that will be coming out with their numbers post-market hours today. So we'll track that very closely. During market hours, you have Bajaj Auto that comes out with earnings. Now, remember, this is a stock that has done phenomenally well. It's up almost 80% in the last 6 months alone. Good numbers. Numbers are expected to be strong. Revenue growth of 25%. Margin stable at 20%. But a lot of the good news perhaps is already in the price. So just keep an eye out on this stock. Those are the earnings estimates for you on your screen. Very strong earnings reported from Angel One. So I'll be watching not just Angel One, which has done really well, but that entire space, right, with the way the markets are doing. Revenue growth of 28%. Client base has gone up 14% quarter on quarter. So that's one stock that you need to keep on your radar. Of course, apart from plenty of others that we'll talk about. But Rima, what are you watching out for?
Well, just a quick word on Asia as we begin trade. Korean markets have surged 1.7%, so there is a lot of buying emerging there. Nikkei is absolutely flat, but with a positive bias, 0.3% up on that. And Hang Seng too has a gain of about 0.7%. So the color across Asia this morning is clearly green. I don't think there are any markets which are in the red over there. That said, the US markets in this month of April have been in a bit of a corrective phase. So as they sift through the Fed commentary, the geopolitics, the key US indices, Wall Street is down on an average 5% in the month of April. In that context, the Nifty is only down close to about 0.8%. And just to add to the cues for the day, the massive Vodafone Idea 18,000 crore FPO opens today. Yesterday, the anchor book was known. They invested 5,400 crore, and it boasts of some big marquee names: GQG, UBS, Fidelity, Motilal Oswal. Infosys, the numbers will be out post-market hours. So the press conference is scheduled at 4:30 p.m. And here, the street will watch for the guidance. Q4 numbers are, a sideshow. They've already done and dusted. But FY25 guidance, broadly, 3 to 5%. But other big numbers, companies reporting numbers, HDFC Life Insurance, ICICI Securities, Mastech, Network 18, and TV18. And today being Thursday, we also have the weekly options expiry.
Okay, so we have our hands full, right, in terms of earnings and lots to look forward to for the markets as well. So without wasting any time, let's kickstart the show and tell you about some market opinion. Jonathan Garner of Morgan Stanley says that the Asia emerging market equities are seeing a short-term correction and a divergence opens up in reaction to a stronger US growth outlook, shallower rate-cutting profiles and the bullish US dollar trends. He says Japan and Taiwan remain well-placed on the US revenue exposure and correlations with the end 2024 Fed expectations, while other markets have deteriorated. He also adds that Japan and India remain their top developed market and emerging market picks.
Let's get you some money market views now. This is Parul Mittal Sinha of Standard Chartered, who says that USD INR has moved higher on stronger US dollar, FPI outflows and elevated crude oil prices amid increased geopolitical tensions. She expects the depreciation in the rupee could be gradual in case of sustained dollar strength, given that forex reserves are at an all-time high. Positive fundamentals, and third, the possibility of policy continuity post-elections is a medium-term positive. She expects the USD INR to trade in the 83.35 to 83.75 to the dollar range for the week ahead.
All right, and on the bonds, Parul says that the Indian yields moved higher on higher US yields as markets paired US Fed rate cut expectations. The US rates moved higher on stronger than expected data and higher oil prices driven by geopolitical uncertainties in West Asia. She expects the benchmark 10-year yield to trade in a range of 7.1 to 7.2% in the very near term.
And we have lots of stock-specific action to track today, and we'll get to it in just a bit. In our special Top 10 segment, we're looking at ICICI Lombard, Just Dial, Brigade Enterprises, Suntec Realty, Ambuja Cement, IFL Finance, Biocon, Jubilant Pharmova and Angel One that are on our radar on the back of positive news flow. Tata Communications is the only stock which could open in the red post its Q4 numbers.
Dean Kim is with us, head of Global Research Product at William O'Neill and Company. He's joining us now. Dean, good to have you with us here. Thanks very much for your time. So on a price action basis, Dean, how are things looking? Is the US looking like there is a bit more of a pullback? Will this develop into a deeper correction? What's your sense?
Yeah, I mean, for now, both S&P and NASDAQ broke below the 50-day moving average. And now the next level support is at the rising 100-day moving average. So we could see some further downside, especially given, as you mentioned, Jerome Powell sort of walking back the rate cut scenario, as well as tensions in the Middle East. The bond yield has spiked up. So all of these things are not great for equity markets, but we are hopeful that the 100-day moving average will act as strong support.
All right. Dean, hi, good morning, and thanks for joining in. So the Nifty, right, is down about 2.5%, 2.6% from the April 10th high of 22,750 thereabouts. On the charts, do you expect more pressure on the index? If yes, what could the floor and ceiling look like as we head into this corrective phase?
Yeah, the index is sitting right at the 50-day moving average. So let's see if we can bounce here. If we lose support, then the next level of support is the 100-day moving average, which is about 2% below. Should we, bounce from here and progress further, resistance is at the 21-day moving average, which is 1% higher. So far, I think India still looks constructive, but let's make sure that we can bounce from the current 50-day moving average.
So the broad range is about 3.5%. On the way down, the 100-day moving average, 21,683, that's 2.5% lower. And on the way up, about 1%, right?
Yeah, correct.
Okay. What about individual stocks? Which ones have, come on your radar?
Yeah, I think there's a lot of interesting names in basic material, cap equipment. So I'm looking at BASF, Solar Industries, Steel Authority, KSB, Zen Technologies, and so on. That's more on the cap equipment side. There's also consumer cyclical names that's popping up. So auto equipment, Sona, BLW, Shriram Piston. Then you have Indocount, Phenolux, and so on. And then I would say, some selected financial names like Muhut Finance, Central Depository Services, and BSE. So those are all, looks attractive from an early stage breakout or setup basis. So it looks interesting there.
Dean, Sonia was talking about the large FPI foreign selling here. And I think what is exasperated that is also the rupee weakness, which has been pretty pronounced. So I don't know if you've looked at the USD INR, but it's not just the rupee. You look at the Korean currency, the Indonesian rupiah, you look at other currencies as well. The Taiwanese dollar, for example, they're all at either new lows or multi-month lows against the dollar. So it's actually the dollar which is rising, hurting all these other currencies. Just thoughts there.
Yeah, basically US dollar has been strong as of late. So we're currently sitting at 106. The problem is if we do break above 107, then there's a gap between 107 and 110. So I think 107 is critical that we stay below that. And the rising bond yield doesn't help the situation. There's a lot of attractiveness for US dollar, especially when bond yields are spiking. And so it's a natural phenomenon that emerging market currencies will, face weakness on the back of the strength of the dollar. So we're keeping a very close eye on it, but it's certainly a headwind for emerging markets.
Okay, it's a headwind for emerging markets. Any thoughts on how to approach the IT names? I mean, it's been steady state for names like TCS and Infosys for the last 6 months. In fact, TCS has given returns of, around 10-11% in the last 6 months. But now, post numbers, there's a bit of volatility in these names. But on the charts, how are they looking?
Yeah, I think Tata Consultancy is basically consolidating at the moment. Maybe wait for a breakout from a base. Infosys, on the other hand, looks fairly vulnerable. It's living below the 200-day moving average, and it looks like it wants to go lower. So I would be careful with Infosys. Just broadly, tech sector in the U.S. has been, it was an outperformer for the first quarter, but then recently it started to underperform. And so, for large cap tech names, maybe stay with Tata Consultancy versus Infosys for the moment.
Dean, a quick word on India versus the rest of the emerging markets. How does India fare?
Yeah, India is actually continues to be very constructive. Just last night, we downgraded Japan and Korea to downtrend. All the other major Asian countries are under pressure, including India. But at least India, you're finding some support at the 50-day moving average, so that's good to see. China was upgraded to uptrend a few sessions ago, but now China is running up against the 200-day moving average. So we'll see if the uptrend can last. But given other major markets like Japan and Korea going downtrend, it may be vulnerable there as well.
All right, we'll let you go on that note. Thanks a lot, Dean, for joining in, and have a great weekend, and we'll of course touch base with you again later. That's the word coming in on the market. India still looks constructive, by the way, but the global space is not looking that great. Let's step into a quick break. On the other side of the break, our entire team will be with us to help us with a list of top 10 stocks as we begin a brand new day of trade. Welcome back. Hope you're having a good morning. So far, the GIFT Nifty is indicating that the start will be in the red. It's not as bad. The implied opening actually is not as bad as what we've seen in the past couple of days. But let's see, we are in a bit of a corrective phase, so don't be surprised if we get a bit of a downtick today as well. But let's start with some numbers. Yash is joining in. He's tracking ICICI Lombard. Yash, how did the numbers look?
Good morning, Sonia. So, month after month, this particular quarter, we've been telling our viewers that the numbers were looking like outperforming the industry, and that's what's happened in the quarter 4 results as well. As far as net premium earned is concerned, that for the company grew by 17%. Now, this is an outperformance of about 400 basis points when it comes to the industry average. So, that's a good thing. And it's not just the premium growth which has come about this time, but operational performance has also shown a very strong growth. As far as underwriting loss is concerned, that is down about 7.5%. The losses come at about 232 crore versus 251 crore. Importantly, combined ratio, the most important metric, that has lowered to 102.2 in Q4 versus 104.2 last year in the same quarter. The management has given a very strong statement on combined ratio, saying that by next year, fourth quarter, they'll be able to reduce it further by about 50 basis points. So that will be very positive for the stock and the company. The company has practically managed to improve its underwriting performance wherever there hasn't been a very strong growth, and in health, it's improved its growth as well. So, of course, a very balanced performance and strong Q4 numbers for ICICI Lombard.
All right, Yash, thanks very much for that. So we'll track the stock as it opens up. Now, Angel One is the next one we are focused on with the fourth quarter review. Vamakshi's got that. Vamakshi, hi, morning.
Well, good morning, Prashant. A strong show from Angel One, I would say, in the fourth quarter. Revenue saw an uptick of almost 28% sequentially, coming in at 1,360 odd crores. And this was largely driven by the highest number of orders that the company recorded at almost 47 crores, which is an uptick of almost 35% sequentially. Not only that, given the highest number of orders, the fee income has also seen a surge of almost 31% sequentially, coming in at around 1,109 odd crores. EBITDA has grown by 33%, and that is because the growth in revenues has outpaced that in expenses. Fees and commission expenses were up 22%, while employee expenses were up 12% sequentially. Now contrast it with the revenue growth and fee income growth of almost 28% and 31% sequentially. And as a result, the margins have also improved for the counter. They've improved to almost 39% and in fact seen an uptick of almost 150 basis points. Net profit resultantly has come in nearly 31% higher, standing at 340 odd crores. So good show from Angel One. Expect the stock to open higher today.
And the stock has been an underperformer. Year to date, Angel One is down 18%, and from its 52-week high, the stock has corrected 26%. So can a strong Q4 push up the stock and recover some of the underperformance? I'm watching two other stocks. One is Tata Communications and the other one is Just Dial, both on the back of their Q4 numbers. So first on Tata Communication, the company has reported a margin miss and a bit of a miss on the top line too. Margins have fallen by 160 basis points on a quarter-on-quarter basis and more than 400 basis points on a year-on-year basis. The reason for the margins coming under pressure is because the company had recently acquired, not so recently, a couple of months back, they had made two acquisitions, Kailera and Switch, and those are reporting EBITDA losses. So margin miss is what can hurt Tata Communication. Even on the top line, the revenue growth is just 1% on a sequential basis. Just Dial, on the other hand, has reported a good quarter. A revenue growth of 16% year-on-year. Margins have expanded to a 4-year high at 26.1%. There you have that margin trajectory on Just Dial. Profits have gone up 25% year-on-year, and this is a company which is sitting on cash of more than 4,600 crores.
Okay, thanks for that. Well, let's move across to the real estate space. We have some updates coming in from Sunteck Realty and Brigade Enterprises. Sonal is here to give us the latest on that. Sonal, hi, good morning.
Good morning, Sonia. Well, operational updates are still coming in. Let me start with Brigade Enterprises. It was the best quarterly sales for the company, and in terms of yearly sales as well, it was the best ever year. On a quarter 4 basis, pre-sales are up 53% to come in at 2243 crore rupees. Volumes are up 18%, and the company says they have a strong pipeline in terms of launches as well. Around 12.6 million square feet in their residential segment, 6.33 million square feet in commercial, and 1.06 million square feet in their hospitality segment. For Sunteck as well, pre-sales growth was strong, up 26%, and this growth has come in after quarters of decline that we have seen, and that's why I'm going with green on Sunteck. Collections, however, were down 32%. The company says they added 7 large projects in the Mumbai region with a gross development value of 30,000 crore rupees, which should see pre-sales coming in the next financial year.
Thank you for that. Moving on to Ekta for more on Biocon and Jubilant Pharmova. Ekta.
Well, I'll start with Biocon because after their launch of liraglutide, which is a GLP-1 drug for diabetes in the UK, they have now signed an exclusive license and supply agreement for the generic version of the blockbuster drug Ozempic, which is basically semaglutide, with a Brazilian company, Biome SA, for Brazil. Now, Biocon will undertake the development, manufacturing, supply. Biome will be responsible for the regulatory approval as well as commercialization. Remember, semaglutide is basically used as used for diabetes. It's a GLP-1 drug. Market size is $580 million in Brazil. But we all know the kind of traction Novo Nordisk's drug has got globally, and the entire segment is expected to probably touch $100 billion by 2028. So that's the kind of potential that we're talking about, or 2030 globally. Now, the other one is Jubilant Pharmova. They have decided to close manufacturing operations of their formulation facility in the US. Now, their subsidiary in the US will continue sales and marketing activities. Company has indicated the extreme price pressure that they faced in the US resulted in significant losses in their generics business in FY22 onwards. So they're changing their model to in-house manufacturing, from in-house manufacturing to an outsourced manufacturing in the US. Separately, their Roorkee facility has received a VAI, so that should help in terms of compensating exports to the US. Overall, they will also look to sell off their land, which basically had the US facility. So that'll probably take place sometime later. So that is something that the street will watch out for. Expect both these stocks to be in the green.
All right, Ekta, thanks very much for that. Well, Ambuja Cement is the next one we want to focus on. Sudarshan has got details of this one. So good morning.
Morning, Prashant. So, promoter Adani family has completed the warrant subscription, and with this, total fund infusion increases to rupees 20,000 crore and holding of the promoter increases to 70.3%. In the latest tranche, warrant worth 8,339 crore is subscribed. Earlier in October 2022, promoter had infused 5,000 crore, and in March 2024 had infused 6,661 crore. So what will this fund be used for? Company says it will be instrumental to achieve 140 million tons per year capacity by 2028, and fund will also enable strategic initiatives including debottlenecking the capex. Commenting on the same, the CEO says fund infusion provides capital flexibility for fast-track growth, capital management initiatives and balance sheet strength.
Okay, thanks for that. Well, let's go across to Abhishek now. He's going to track, he's tracking IIFL Finance. Abhishek, why is that?
Well, IIFL Finance has announced a right issue. So for one share will be issued for every 9 shares that you held in the company. In terms of total fundraise, it's close to about 1,272 crores, which is being priced at rupees 300 per share. So this 300 per share is at a discount of around 30% to the CMP or last closing price of IIFL Finance. Calculation shows that equity dilution could be around the 11% level, 11.1% to be precise. And CRAR, that is capital adequacy ratio, that can increase by 2.25% to 2.5% depending on where their RWA stands, which will lead to close to CRAR of 22%. So this fundraise would actually help them in terms of controlling their cost of funds. We are in a rising interest rate scenario until and unless the funds are used for provisions. Back to you.
All right, very helpful there. Thanks a lot for that. Well, let's do a quick recap in case you missed out on any of these stocks. Stocks with positive news flow, there's ICICI Lombard, Just Dial, Brigade Enterprises, Suntec Realty, Ambuja Cement, IIFL Finance, Biocon, Jubilant Pharmova and Angel One. While the only stock on our radar with negative news flow, and of course because of earnings, is Tata Communications. But let's also get a quick grip on what's happening in the world of commodities, because Brent crude, after rising for many days, has finally softened a bit, much to the relief of investors. But Manisha Gupta is here to give us a roundup of all of that. Manisha, morning.
Thank you for that, Sonia. Well, we had a truncated week, but in the U.S. markets yesterday, we did see crude oil prices decline by 3%. So we are trading below 90, and 87 is where we are resting right now. The reason for such sharp decline is the EIA report, which is suggesting that the U.S. crude inventories have surged by 2.7 million barrels. This is much higher than what the street was anticipating. But then again, there are reports about U.S. looking to reinstate oil sanctions on Venezuela. The European Union is talking about fresh curbs on Iran. So these factors will lead to some buying back coming in case of crude prices. But the only space that has continued to shine bright has been the metal sector. Of course, the precious metals are doing well, but the ferrous metals, the base metals also seem to be surging fine. Copper is trading 0.5% on the higher side right now. Aluminum prices have surged to a 22-month highs, and the laggards like iron ore are trading on the positive side. Even the steel prices firmed up by 2% in early Asian markets today. So the anticipation that demand is improving, better economic data from the global manufacturing markets, all of that seems to be supportive.
All right, Manisha, thanks very much for that. Commodities and metals have been doing good, and we'll track them this morning as well. We'll take a quick commercial break here. Deepan Mehta of Elixir Equities will join in for some stock-specific commentary on the other side. Stay tuned.
Welcome back. Deepan Mehta, Director of Elixir Equities, is with us now to talk about some individual stocks which should be on your radar this morning. Deepan, morning. I hope you had a good holiday yesterday, a restful one. The first question is on Vodafone Idea. Would you recommend that retail shareholders participate in this FPO?
Yeah, good morning, Rima, and thank you for having me on your show. I think yesterday was a great holiday. In between the week, a holiday is always welcome. So coming back to Vodafone, I think that it's great for Vodafone's long-term prospects that they're raising money the way they are. And as if this is going through successfully and it's followed up with some more conversion of debt by the government, then clearly Vodafone would be well on its way out of its woods, and it'll attract even more investors, and fundraising in future may be easier. But, there are a lot of ifs and buts over here, and, one needs to really see solid fundamental performance before you can look at Vodafone as a long-term investment idea. From the FPO point of view, I think it's a great opportunity for investors to flip their holdings because it will be at a 10-15%, maybe even a 20% discount to the stock price. And that does provide an arbitrage opportunity. So I think that it'll get good retail participation just on account of investors' strategy to try and flip the stock once they get the allotment. And you could have a sell-off in the stock post the listing of the IPO shares. But by and large, it's very positive for Vodafone and also very positive for Indus Towers. And I'd like to play this entire thing through Indus Towers rather than Vodafone Idea. Having said that, it's a company, Indus Towers is a company in which we and our clients are invested in as a measure of disclosure.
Okay, got it. Deepan, hi, good morning. I wanted your thoughts on Angel One. I mean, the numbers have been phenomenal, right? Almost a 30% revenue growth. The client base is up about 15% quarter on quarter. But the stock has also done really well. In the last 1 year, the stock is up 120%. At this price, is the risk reward still favorable for investors?
Yeah, good morning, Sonia. Very, very impressive numbers from Angel. And I had certain reservations because of a lot of regulatory changes taking place whereby brokers could not keep margins of their clients, and those sort of issues were there. But now I think they're well behind, and it's further continuing on its journey to become a full-fledged fintech player. So from that point of view, I think the company has got great prospects, very aggressive management, which has demonstrated its execution skills as well. I think valuations also are quite reasonable. So I would say that it's a great company to look at from an investment perspective. And if they continue to report these kind of numbers, then I think the stock can certainly go higher. And I agree that the stock has rallied by 120%, but also from its highs is corrected by about 20-25% also, if I'm not mistaken. And I do feel that, compare it with some of the other fintech companies or NBFCs, the kind of growth dynamics and growth profile is much better with lower risk.
Deepan, hi, morning. Jio looming with their venture doesn't make you nervous? Jio Financial?
Good morning, Prashant. Prashant, I've been in the financial services industry for almost 3 decades. And it's not like setting up a petrochemical plant or, setting up a telecom network. Because it takes, that's something which you do the project and the revenue start coming off. You do a 10,000 crore project, 20,000 crore project, and then once it gets commissioned, the revenue start to roll in. Financial services is basically a very slow business. It is very manpower oriented. There are many, I would say, from an organizational perspective, many systems need to be put in place for risk management, which is the most important thing. And while it's easy to kind of, get the book going, but to sustain it continuously and then to have the collection efficiencies in place, to set up the right tech platform, I think these things take time. It cannot be done just in 1 or 2 years or so. And mind you, it's an industry where there are many players, and to an extent there is there's pretty much level playing field. So from that point of view, just having the advantage of low resources or the brand of Reliance is not going to be just enough. It's a lot to do with manpower management and, as I said, risk management systems as well. So while the prospects are great for Geo Finance, I just want a demonstration as far as the basic business model and how the numbers are going to come through before I look at investing in it. So from that point of view, and of course, the stock also has run up. So looking at the entire risk return profile, I would give Geo Finance a pass.
Okay, give Geo Finance a pass. Got it. We'll just come back to you, Dipan, in a bit. We also have the auto sector in focus today. The first of the auto numbers will be out. Bajaj Auto comes out at noon. Abhishek Gaushinde, Deputy Vice President Research at Sharekhan by BNP Paribas, joins us now with his call on the sector. Abhishek, good morning and thanks for joining in. First on Bajaj Auto, the stock has had a dream run in the last 1 year. Numbers are also expected to be strong, but what portion of that you think is already in the price? And what is your expectation from the numbers and your recommendation on the stock?
See, on broadly, we see that Bajaj Auto has witnessed 11% QOQ decline in the volumes, but its product mix has been improved. That export mix and the CV mix has been better than that of the Q3. So that would support and partially offset the volume decline. Broadly on the margin side, we expect that it would sustain its 20% margin trajectory. And for last 2 quarters, it has been reporting an EBITDA of over 2,000 crores. So that journey will be continued. Over 2,000 crore kind of EBITDA will be there, and that would be percolate to the bottom line. So broadly, numbers are expected to be decent, but what would be the going forward is that although stock has been run up and the valuations are in catching up, but what we are liking in this stock is that so far we are not seeing earning downgrade cycle or earning miss kind of a thing. In last 4 to 6 quarters, we have been continuously seeing an earning surprises. So as long as the earning downgrade cycle will not start, or the company will not disappoint us on the continue to surprise us on the earnings side, I think that it would sustain this valuation. As you know that we have been arguing for a re-rating in the stocks like Bajaj Auto and the Hero MotoCorp. So that has been now quite visible.
Abhishek, there's one more angle to this, right? The EV business, with the expected IPOs of Ola and Ather, the expectation from the market is that these premium valuations could perhaps sustain because of the buzz there. Your thoughts, and how do the valuations of Bajaj Auto now compare to some of its peers like Hero and TVS?
So I'll take first of your questions. That definitely that since we have heard about this IPOs from this new players, especially the EV players, both these stocks have been seeing strong run up and upgradation and the valuation re-rating. See, it's very simple that if you start thinking about for 4 or 5 years back, that there was a concern that whether this player would be able to sustain this disruption or not. But now the thing has been completely changed. All these 3 players, if we consider Ather as the representative of Hero MotoCorp, so Hero MotoCorp, Bajaj, TVS are the part of a top 5 players in the EV space, which are being considered as a kind of a concern for them. So definitely, if this IPO would come, then it would be again convert into a re-rating or the value addition for this kind of players. Second is on the valuation side. Yes, valuation, it has been re-rated. Now it is trading at 25-26 times its FY26 earnings compared to the Hero MotoCorp, which is at 17 times, and the TVS Motors, which is close to 30 times on a plain vanilla basis. So broadly, at the cost of a reputation, I'll again say that as long as we have earning drivers available in the space and we are seeing earning surprises, this high valuation would sustain, given that the overall business trajectory for the company has been changed. Its key growth driver, which is export, that has not yet been that reflected in the numbers. Export is still weak, but despite that, its performance is driven by the domestic performance, and side by side the improvement in the export mix. So if this thing will continue, I think the current valuation would sustain.
Abhishek, morning. You said Bajaj Auto is trading at 25, 26 times forward PE, while Hero MotoCorp is, I think it's 17 times. Will the valuation gap between the two continue according to you, or is there a case that Hero MotoCorp now catches up?
See, Hero MotoCorp has also catched up. You see, earlier Hero MotoCorp was trading between 13 to 14 times, but as its new product cycle has been well accepted in the market, and second that its introduction of its iconic premium motorcycle, this Maverick, and this Harley Davidson association. So that is also helping it to Hero MotoCorp also. A substantial this valuation gap will breach, but I think Bajaj, in the terms of the valuation, the Bajaj Auto will continue to take a lead compared to the Hero MotoCorp, given that it has a larger room to expand its earnings compared to that of Hero MotoCorp because of the margin side. Hero MotoCorp's margin is guided margin is in the range of 14 to 16%. In last quarter, its reported margin was 14 and the adjusted margin was 16%. But Bajaj Auto has been continuously reporting 20% kind of a margin despite being dragged from its EV business. So this margin, this valuation gap will remain. But as the Bajaj Auto's valuation would improve, that would also reflect into the improvement of the valuation of Hero MotoCorp also.
Abhishek, hi. What about Exide? If you've looked at, if you have coverage and if you have thoughts here, so taken off like a rocket from 300 to 450 in 4 days.
Yes. So 3-4 days back already we have discussed on the Exide side. So what is really happening in the Exide is that earlier it was there are n number of concerns about its business. Now it's excluding its this existing business. With this association with Hyundai and Kia, the street has been now getting comfort that its EV business will take off. Although the stock has run up so much, so some kind of a profit may come, but eventually we are constructive on this this battery space because of their eventual entry into the EV business. Until or unless it was a fear that their existing business will get collapsed and there would no future for this kind of a companies. But when this EV, their comfort in the EV business are coming there, then the street would definitely give them the higher valuations at which compared to their past valuations where the street was building up the pessimistic case for this kind of stuff.
All right, Abhishek, we'll leave it at that. Thank you. Very helpful, actually, all your comments on the auto sector, and thanks for joining in this morning. Dipan Mehta is still with us. Dipan, you know, this move on Exide has pretty much come out of nowhere, right? Of course, it was a potential for the company, EV batteries, but suddenly Hyundai and Kia coming out and saying, you know what, instead of producing the batteries in-house, we're going to outsource it to cheaper manufacturers like Exide. I mean, that's a huge business potential. Do you think it's factored into the price, or could there be more to go?
See, I think it's still work in progress, Sonia, because the technology has to be established. Basically, Exide is not a lithium battery player, and they're dependent on external sources for technology. And there are execution risks also as far as their lithium battery plant is concerned. And end of the day, the companies like Kia and Hyundai are not the largest players in the EV segment as well. And you know, while in the two-wheeler segment it's becoming pretty clear that Ola Electric is going to be the market leader going forward, something of that has to emerge on the passenger vehicle side as well. So while I think sentimentally it's extremely positive, I don't think for the next 2-3 years it's going to do much for the earnings of Exide Industries. And end of the day, you know, lead acid batteries is a pretty mature business. So from that point of view, I think a lot of the upsides have been captured in Exide. But the view may certainly change if you know, the entire lithium-ion battery business and that division starts to contribute materially, and you see great prospects with even more supplies and production zooming up.
Dipan, what about IFL Finance? The board has approved a 1,272 crore rights issue at a price of 300 rupees. So a steep 30% discount to where the stock currently is. And this comes in the aftermath of the RBI banning it from dispersing gold loans. So the stock is corrected, but it's trying to find its feet. This rights issue, how would you view it?
So I think it's investor-friendly move because certainly the discount is quite significant, and any resources coming into an NBFC immediately start to benefit in terms of higher net interest margins. But gold loans was a great growth driver for IFL Finance, and it was something in which they had created a fabulous niche and market share in a competitive industry. But the setback, I think, I'm not sure how it will actually play out. But look, IFL Finance management is extremely aggressive and I would say quite dynamic. So they'll work around these issues and they'll find solutions. And most importantly, the valuation of IFL Finance compared to its peer group is extremely attractive given its size and diversity of its loan product offerings. So from that point of view, I'm quite positive on IFL Finance. But you should brace yourself for 2, 3, maybe even a year of soft performance, which I think has got captured in the stock price. But the long-term prospects are very good. And, 1 year down the line, you could expect the growth momentum to pick up. And I'm pretty certain that, P multiple or price to book has to get re-rated if, the growth rates tend to pick up.
Dipan, stay with us because we are going to come back to you with more. I mean, IT services is another area I want to sort of spend some time talking. Sold off on Tuesday. Large caps, mid caps as well sold off quite aggressively. But for now, Anuj is standing by with what he's making of the market setup. Anuj, good morning. There's a bit of relief as far as oil goes this morning.
Absolutely, Prashant. Good morning. And, market's got some good cues going for it. Let's see if today we latch on to them. There's, of course, a combination of domestic and global cues. Infosys numbers post-market hours and Bajaj Auto also post-market hours. So I think that could be the most important cue, especially Bajaj Auto, given the kind of domestic economy that we are in. The risk, of course, is from global market with Fed Chairman Jerome Powell putting a bit of a risk on the interest rate cuts, especially with that core inflation data remaining a bit sticky. But domestic earnings are very strong. Look at Angel One. It tells you the kind of market we are in or kind of domestic economy we are in. The other thing I'm latching on to is FII positioning in index futures. And once again, it tells you why, whenever FIIs are long, the markets actually fall. And when they go short, the market rises. Look at that, 59% long. They were just about 7 days back. And now we are at 36,000 short. So I think that's also another good cue to look at. Put call ratio also at 0.76. Normally, that's the bottoming out zone, 0.65 to 0.76. So let's see. On the Nifty, it's all about 50-day MA, the 50-day exponential moving average. We closed just above that. That's the support, 22,080 to 22,120. That's also where Tuesday's low was. And the bigger support is 21,920 to 21,970 today being expiry, looking at the weekly option side. On the upside, the first resistance is 22,214, Tuesday's high, and then 22,260 to 22,325 based on options. If you start to cross 22,260, expect big short covering. On the Bank Nifty, the support is 47,316, Tuesday's low, and then 47,223, again 50-day exponential moving average. And resistance comes in at 47,609, Tuesday's high, and then 47,720, 20-day exponential moving average. I'm watching out for Nifty IT also very closely today. It's in a make or break zone, the Nifty IT that is, very close to 200-day moving average. Tuesday's low was 33,504. The current 200-day moving average is 33,440. Since June 2023, which is when it started to outperform the market, it's not spent a day below the 200-day moving average, 200-day simple moving average. So in that sense, it's very important because Infosys comes out with numbers. Going by the price action, it looks like the market is expecting a shocker from Infosys in terms of guidance. That could be the reason, why it's fallen like it has over the last few days. Infosys itself is already below 200-day moving average. And one thing about IT stocks, TCS, for example, you could argue the numbers were not great, but the numbers were not bad either. So, but it could not sustain any kind of rally, and it's also approaching the 200-day moving average. So the index is weak, but very close to 200-day moving average. Sometimes, things bottom out with the worst of the news. So let's see if that happens with Nifty IT. Very quickly, I'll leave you with quote of the day. It's a good one. I mean, I like this one. It's better to fail in originality than to succeed in imitation. So that's the quote.
Okay, we missed you, Anuj. I think I missed the quotes more than, your market update. So welcome back.
Thanks, Sonia. I missed being here and being in Mumbai. I tell you one thing. This no better place than Amchi, Mumbai. So just missed that and happy to be back.
Where did you go? I mean, now that you...
I had gone to Singapore. I had posted an image. I had gone out with Samir also.
Yes.
Yeah, I liked it, but happy to be back. Yeah.
What about the weather?
That's
you
what
can't
I'm
say
saying.
that about Mumbai weather.
Trust me, Sonia,
Bombay
go
weather.
to Singapore, spend a week there. You would love Mumbai weather. Trust me on that.
All right, Anuj, thanks very much for that. So that's a nice quote, and of course, a setup on the markets as well. Let's take it back with Deepan. Deepan, we were talking about IT services. Anuj also mentioned that from a technical perspective. What's your sense here?
Yeah, I think that TCS results are okay, and there are not much expectations from Infosys. So it's pretty clear that neither the performance nor the management commentary may be as great. So let's just wait and watch. I think we're getting into the earnings season. A lot of IT companies will come out with numbers in the first half of this earnings season. You should expect slower growth rates, but everything depends on the management commentary and how they see the next 2-3 quarters or so. Intuitively, I'm quite positive on IT because this entire AI, generative AI, chat GPT, that could be a big new wave for IT services and could lead to significantly higher spending, a lot of which will come to Indian IT services. But we have to yet see the evidence of that at the ground level. I mean, the companies have won significant transformational projects, but it's not yet, got into mainstream like some of the other kind of activities which these companies do. So I'm just watching the sector very closely. I'm not, buying into it or selling. Just wait and watch, and let's see how it plays out.
All right, Deepan, stay with us. We'll take a break here. Mitesh and Kush Bora will be with us on the other side. We'll get you some technical trading ideas as well. Stay tuned.
Welcome back. Let's get you ready for today's trading action. Mitesh Thakkar and Kush Bora are now with us. Gentlemen, good morning. Mitesh, first, the index structure.
Good morning. So, I've been calling for some kind of a decline on the markets in the last few days, and we've seen that correction play out. Now, the structure still remains weak, but there's one data point, which I would want to highlight, which is the put-call ratio, which is now hovering below 0.65, 0.64 range, which is where typically you see short-term bottoms being made. So I think today's gap down, my first reaction would be to cover some kind of short positions, let's say half of it, and then trail the stop loss to yesterday's low, which is, with Tuesday's low, and then see, if there is some kind of a pullback happening. Maybe, with the options data slightly turning positive, there could be chance of short covering from lower levels. But at higher levels, around 22,250, again, I think, there will be selling coming in. So the idea is that the bias is slightly on the negative side. Tactically, today, you would want to take some profits on short positions and sell on rallies again.
All right. Kush Bora is also with us. Kush, your view on the index?
Well, fairly similar. If you see the support zone of 22,000 to 22,200 is acting on the Nifty. Even Bank Nifty, I think 47 to 47,400 is a support zone. Another data point to add to something what Mitesh already said. If you look at the put basis for this weekly expiry, then you've got the 22,200 call, but the 22,000 put also has an equally strong base. So what will happen is perhaps there will be some sort of a recovery and the market will try to come to that 22,200 kind of zone. So for me, that remains a pivotal zone. I don't expect a V-shaped kind of a recovery. Perhaps some consolidation, perhaps some positive bias for the week or for the week till the expiry passes by. And I think the stock-specific action will be a plenty. Bank Nifty, incidentally, is turned weak. There was this brief moment of shine, but if you see, some of the heavyweights are also giving way. So Bank Nifty, I'm a little cautious on. Nifty might perhaps have a positive bias, but I think we don't expect a V-shape kind of a recovery here.
Okay, some stock-specific trading ideas then. Mitesh, what do you have for us?
I'm beginning the day with more of sell calls purely because the structure and the GIFT Nifty indications are on the negative side. But as I said, I think, with the gap down, if there's no follow through, I'd be very quick to cover shorts and trail my stop losses to a tighter positions. So on the sell side is Adani Enterprises with a stop at 3150. Look for targets of 3,000 here. Persistent is a sell with a stop at 3,900 for targets of 3770. Sell on TVS, which is a conditional sell. If it starts breaking below Tuesday's low of 1960, then go short with a stop at 1985 for targets of around 1900, maybe just below it. And a buy on Ashok Leyland with a stop at 172 for targets of 185.
All right, Kush, what about you?
A couple of stocks, both of them on the positive side. Aarti Industries, from this space, this stock has been actually doing wonders. This momentum is expected to continue. If you see, the volume also has seen a bit of a pickup last week. So I think Aarti Industries will continue to rise. 775, 779 are the targets. 730 is where I would place my stop loss. The power space has been doing well, and most of the stocks and subsectors in this have been doing well. So within that, GPIL, Godavari Power, this is one stock that we have on our radar. We've been recommending this to our clients also for a while. 875 and 900 are the targets. 820 is where I would place my stop loss.
All right, gentlemen, we'll have more stocks with both of you, but thank you very much for joining us with that wrap-up in terms of actionable ideas. We'll take a break. We are back. We'll be in conversation with the Vodafone Idea's top management about the 18,000 crore FPO, which kicks off today. Stay tuned.
All right, let's go across to Chandan Taparia to give us some F&O cues for the day. Chandan, hi, good morning and thanks for joining in. Any thoughts on individual stocks and also on the index? How are you positioned now?
Good morning, Sonia. Thanks for having me. The Nifty and Bank Nifty both are making lower highs, lower lows. So we believe till Nifty holds below 22,222, it can decline towards 22,000 zone. Bank Nifty 47,777 is hurdle. So till these levels are not surpassed, we may see some more decline. Now looking at the stock wise, first there is buy on HL, that is Hindustan Aeronautics Limited. It has given a pole and flag breakout. Momentum is clearly visible. It is making higher tops, higher bottom on the weekly chart. So recommending to buy with support of 3640 and looking for an up move towards 3880 level. Second idea, that is buy on Escorts. We have seen buying interest in selective auto name and especially the stocks which are from rural India after the IMD monsoon report. So Escorts is one of the counter which is making higher base. We have seen the base near 2930, 2950, and because of that, momentum could continue towards 3200. One can buy with support of 3000 zone. Last trading idea, there is buy on Coforge. We have negative view on most of the IT name, and Coforge is the counter which is making lower top, lower bottom. We have seen a breakdown, built up of short with call writing activity also indicates the downside target. So Coforge we are recommending to sell with stop loss of 5320, and here we are expecting a downside target towards 5000.
Chandan, thank you very much. Very helpful. Appreciate you joining in. Mitesh is still with us. Mitesh, one of the big movers on Tuesday was VA Tech Vabag. We were on Tuesday talking about stocks making new highs. CSB Bank was one. VA Tech is almost at its previous all-time high. 30-second response on this one.
Prashant, the stock has rallied from 250 odd levels and still looking strong to me. I think the earlier monthly high was 855, and I think, this is now heading towards 1200 plus levels. The only thing is that slightly overbought in the short term, so you may want to buy it in piecemeal fashion. But I think this is, it still has about 20-25% kind of an upside left.
All right. Okay, Mitesh, thanks a lot for that. Well, let's move on. Vodafone Idea's 18,000 crore rupee FPO opens today. The company has raised around 5,400 crores from anchor investors. Reema caught up with Akshay Mundra, who's the CEO of Vodafone Idea, to talk about the FPO details and their business outlook. Listen in.
Vodafone Idea has launched a massive, the largest ever FPO of 18,000 crore rupees, and the anchor book boasts of some big names: Fidelity, GQG, UBS, and the anchor book has raised about 5,400 crore. Joining me today is Akshay Mundra, CEO of Vodafone Idea. Akshay, thank you very much for joining in. You've got some marquee investors on board, foreign and domestic investors. The question is, what next now?
So, Reema, very happy to be here. And let me just say, while you mentioned some of the names, which is GQG, Fidelity Management Research, UBS, there's also RWC there in the foreign portfolio investors. Amongst the domestic, we have very good names like HDFC Mutual Fund, Motilal Mutual Fund, Quant Mutual Fund, and there are also some insurance companies. And one of the strong points of the anchor book is that the allocation to hedge funds is less than 5%, which speaks for the strength of the anchor book. What next? First is we still have the 70% of book build process to be completed, which should We are working over it, and the last day is 22nd. But let's say, what do we do with this funding? That's the main question. And we are going to use this basically for growth capex. This is not the only funding we are doing. This is a part of the funding, 18,000. You are aware 2,075 crores will come from promoters. And we are also in discussion with our lenders. And the way the funding is being raised is to have a total availability for growth capex, which can meet our requirements for 4G coverage expansion, 4G capacity growth, and the 5G rollout. And when we do this, we are confident that we'll be able to arrest the loss of subscribers and start participating in the growth of the industry, which we have missed out for the last few years.
So talk to us about your capex plans, because that is the necessary input to arrest your subscriber decline. From the FPO proceeds, it's 12,750 crore, which is outlined and earmarked for your capex.
Right.
Once you get the bank funding in, and out of the total capital raise of 45,000 crore rupees approximately, how much goes into capex? And if you could break that up in 4G and 5G.
So let's say, again, I can't give you specific guidance, but let's start with the FPO proceeds. 12,750 for capex. Spectrum is about 2,000, but spectrum is, we don't need to buy much of a new spectrum. So the split of 12,750 crores is 5,720 for 5G rollout, and the remaining 7,000 is for 4G, roughly equally split between 4G coverage expansion and 4G capacity growth. I would say this spread is also largely the mix of our larger capex. That's why this is reflecting in the RHP. So this would be there, but just to make a point that while we need to grow the 4G capacity, we need to roll out 5G. The reason why we lose subscribers disproportionately today is only because of lack of 4G coverage. And today, our share of new customer acquisitions is actually higher than our customer market share. So the only thing we need to arrest is the loss of subscribers, and which I'm very confident that once we are able to plug this coverage gap, we should be able to do much better than where we are today.
How soon before you start participating in growth? Do you have an internal assessment on where you want your revenue market share to be? You started off at a much higher number, but say in the next 3 years, do you want it to rise to 25%? Is there a number that you have in mind?
So again, we have a number in mind. I will not be able to share that with you right now.
In the mid-20s? Is that fair? Early 20s?
Let's say we should improve our market share. And what happens is, and you can see there are cases in the past, whenever an operator has expanded their coverage to participate in a larger geography, it is inevitable that some improvement will happen. This has happened multiple times in the past. How much, when, I'll leave it for your judgment and the audience judgment, but definitely there are precedents available when anybody has expanded their coverage to fill the gaps vis-a-vis competition, they have benefited from that.
Okay. And on 5G, why are you only targeting covering 40% of your revenue base in the next 2 to 2.5 years when your peers already have a pan-India rollout?
So I think 5G, let's say that is our plan today. It could be modified. That is how we see things today. And you would have seen what has happened with 5G is that on the consumer side, there is not so much of 5G use case, and monetization has been a challenge. I think when the rollout happened a year ago, there was this sense of that when 4G came out, somebody missed out, so we should roll out quickly. Can it become a factor in terms of, again, gaining disproportionate market share? Now, we've had 5G for a year. We've not seen that happening. And the major difference there is that when we moved from 3G to 4G, on your phone, you could see a very big experience difference. 5G, that is not the case. The speed is much higher. But in terms of what you see on your small screen, that is not such a discernible difference.
Now on the question of how and when on tariff hikes, right? Your ARPU is 145. What is your own internal assessment? When can the first tariff hike take place, quantum, and the next one?
So one is that the Indian ARPUs are the lowest, and I think lowest not by a small margin, by a big margin. So that is the important factor. The second thing to be kept in mind is that today, none of the players are returning their cost of capital. And it has not been just a year or so, it has been 5 or 6 long years. And that was the scenario when 4G investments were made. 5G investments have added on to that, and 5G monetization is still not to be seen. So the imperative for tariff correction just to get to a return on cost of capital being there.
So what should the ARPU be for you to be able to return your cost of
Again,
capital?
I'm not at a liberty to say that, but there is enough commentary from our peers, and I would say that
300? That's the commentary from your peers?
So that number appears to be right.
Okay. So ARPUs need to be at 300 for the industry to make a return on their
in the current
investment.
form and the current level of 5G investments, of course, anything is related to the size of investment. And as things stand today, that looks like.
Okay. So guide the market, right? The street is expecting today that we will see a tariff hike post-elections of a magnitude that we've seen in the past, which was 20%, right? The last two tariff hikes were 20%. So guide the market. Is this a fair assessment in your own mind?
So I would describe it like this, that I cannot say what would be the next price increase, when and how, but I would say that generally speaking, we have seen that this quantum of price increase is absorbed in the market without much of an implication. So I would say that the consumer at this level is willing to accept, and I think generally we've seen in India, you meet many consumers, they are happy to say that, okay, we are willing to pay a slightly higher price or slightly higher ARPU, but we want better services. So I think...
So 20% can be absorbed if we see one.
I'll not say that, I'll leave it, I've told you enough to...
Okay. So what's the way forward once the moratorium comes to an end in September of 2025? Do you think the company can generate enough cash flows to meet the government obligations?
Okay, let me say, as I mentioned, that our new funding is largely for growth capex, and our plan to meet the existing debt, vendor payments, and the government obligation is out of internal accruals. Now, of course, we expect the internal accruals to improve as we make investments. The only thing I would say is that you are aware of the reforms package, and the reforms package has a provision that post the moratorium, the deferred installment series which is there, the government can convert that to equity. So I think this is somewhat into the future. Probably we will need government support for some time, but over a long period of time, we believe that our operations should be sufficient to meet these obligations.
But September 2025 is a year and a half away. You think at that time some more government support will be needed?
That is there in the package, that was given there for a reason.
So there is a high chance the government will convert some of the installments into equity in your own math?
Could be, that could be a possibility.
So that means further dilution, right?
Yeah. But I think the way you are talking about dilution, it looks like it's not a good thing to happen. And let me clarify that point, which I've tried to clarify to some investors also, is that dilution is not good when out of your total capital employed, equity becomes disproportionately higher, because then equity is considered to be the costly capital. In our case, we have a leverage balance sheet. So on one side, you will hear people saying that we should reduce our leverage. How do you reduce your leverage? One, by improving your operations. Second, by getting more equity. Now, whether that equity comes from external investors or it comes from the government doesn't really make a difference. So in our situation, dilution is not a bad thing.
Okay. But is there a threshold below which the promoters do not want their stake to go down below?
I think that's a question you have to ask the promoters. I run the operations. I can only answer for the company and the management.
Okay. And since we're on the subject of the promoters, since it appears the cycle may be turning for the company, right? You've gone through troubled times. What about, why didn't Vodafone PLC participate in the preferential issue? When ABG Group put in money, more than 2,000 crore, why didn't Vodafone PLC put in money?
I think there are two things, and we have to see this in perspective, because sometimes we just tend to see what is happening today. Let's see, in 2022, we had raised capital. And in fact, at that point of time, we were in the process of raising the complete fundraise. Unfortunately, the government conversion got delayed at that time, and so the external fundraise got delayed. So if you see between 22 and now, a total of 7,000 crores of equity, including the forthcoming equity by the preferential issue, has come, out of which 4,000 crores has come from Vodafone Group and 3,000 crores has come from ABG. So it's not that Vodafone Group has not invested. Yeah, you are aware it is their stated policy that they would not bring capital from outside India to India, but their Indian assets can be redeployed, which is what they've done the last two times.
Okay.
So when they invested in the rights issue, they used the Indian assets. When they've invested capital in 2022, they've used the Indian assets, and they have some more of it left.
Okay, got it. Now, since the company is on a growth path, right, the money that you're raising right now, bank plus equity. This will suffice you for how long, according to you? And if you could give us a capex number for 3 years.
So again, I'm not allowed to share the exact number, but as I said, the money that we are raising through the FPO preferential issue and the debt funding is meant for growth capex, and I believe it should cover our capex requirements for the next 3 years or so.
All right, that is Vodafone Idea talking about the way forward. But let's get back to the market because we have a pre-opening rates that have kicked in. It's not bad, to be honest. It's up about 65 odd points for the Nifty. So, stable above the 22,200 mark. Mitesh is back with us. Mitesh, what's the big call at 9:10?
I'll go with a buy on Ashok Leyland with the stop at 172 for targets of 185.
Okay, so a buy on Ashok Leyland. Got that. Vivek is also with us, my colleague. He's going to talk about the power transmission sector and why you should keep that on your radar today. Vivek, over to you.
Well, good morning. A very interesting note coming in from Goldman Sachs today as far as the entire power transmission space is concerned. What they've done is they've analyzed, India's power capex requirements, as India is transitioning to a renewable energy capacity addition. So what they're saying is that transmission capex will have the second largest share as far as the government spends are concerned. In fact, they're saying that India could see $500 billion of transmission capex over the next 25 years out of the total envisaged $1.7 trillion that will be required to go ahead and build India's infrastructure. Along with that, they're saying that the government is providing financial support worth almost $270 billion for energy transition by waiving central grid charges for renewables. So on the back of that, what they've done is they've initiated coverage both on Power Grid, which is India's largest transmission player, as well as power equipment suppliers for this particular transmission network development. So Power Grid, they have a buy rating on the stock. They have a target price of 355 rupees a share. They're saying that India's largest transmission asset developer is the top pick. It is a play, as per them, on the grid capex super cycle with a large balance sheet. Along with that, the company also enjoys a low cost of funding. Hitachi Energy India is the second stock on the radar. They have a buy rating here as well. They say that Hitachi Energy could be amongst the largest grid equipment suppliers, and it is also a China plus one play as far as India is concerned, given that they have an indigenized solution provider. And lastly, Schneider Electric, they like the company, but they have a sell rating on the stock. They say they like the company for the technological capabilities and strong presence in the medium voltage segment. However, at the current price, risk reward is unfavorable given the fact that the stock has seen a 4.7 times rally in the last 1 year.
All right, Vivek, thank you very much. Interesting list there from the power segment and on the equipment side really coming through. We spoke about some of the big movers. The other, Mitesh is still with us. Mitesh, any thoughts on, Senco, which continued to move higher, and Tuesday was again a very large move for that one.
So Prashant, I think, the stock has had a breakout from a rising consolidation, which happened actually on Monday. And then we saw some continuation on Tuesday. The worry is that the chart history is not much, to see any kind of extension targets also. But whatever I can manage from here is that the highs of 1050 should not only be crossed, but eventually we should see the stock head towards maybe around 1200 levels. Again, I would be a buyer in case the stock dips and gives an entry around 940 points.
All right, lots to track. Mitesh, thanks very much for that. We are sort of running into market opening, which we should have in just a bit from now. The market, as we were indicating, a bounce perhaps is what we will get. Now, will we run into resistances very, very quickly around the 22,200 to 22,500 gap area as we were discussing, or will this have a little more strength? I think it'll be a bit tentative, at least today. So we'll see. But just the first rates up on your screen now. We'll look at indices and we'll look at specific stocks as well. So 22 gap area with this start. So 22,200 plus is where the index is starting at. 73,216 coming through there. Bank Nifty is up about 0.6. Bank Nifty, of course, saw the stronger bounce from the day's low on Tuesday. Come up with first rates as well. There you go. 1% of the Nifty small cap index.
Well, as you suggested, right? It's look at it. The Nifty is up almost about 90 odd points. There's a fair bit of recovery that we're seeing this morning, which is of course comes out with numbers post-market hours today. So that's stock ahead of it. It's been a really strong stock. I mean, it's up 75% in the past 6 months. Numbers are expected to be strong this time, so the stock as well is in the news. % higher now, very strong earnings, revenue growth of 30%, client base is up 15%. ICICI Lombard 3% higher this morning on that stock. Strong numbers, net premium earned is up 17% year on year. Let's move to Tata Communications because it's a weak set of numbers. The margins have actually missed street estimates. While the revenues are up almost about 16.5%, the margins have expanded to a 4-year high. Clearly one of the top movers. Let's just get back to Just Dial because there's a big move both in terms of price action as well as volume action on Just Dial. So that one I think is up almost about 8% or so. Don't lose sight of the move over there. Brigade Enterprises 3.5% higher on that stock. Highest ever quarterly sales in Q4. So Brigade Enterprises also on our radar. All of these real estate stocks, in fact, have been doing pretty well. Suntec Realty is the other one. Q4 pre-sales have gone up 24%. So Suntec Realty is up 2.5%. Then let's move to some of the larger players. Ambuja Cement, if you're wondering why it's up, the Adani family has completed their warrant subscription for Ambuja Cement, so up 1.5% there. IIFL Finance is in the news for a rights issue. There's a fundraising of almost 1,300 crores there. And the big boy Reliance is in focus. This time, after a very, very long time, the company comes out with earnings on Monday. It's always on Friday post-market hours, but this time on Monday, the street is actually quite bullish on Reliance ahead of its earnings. So let's see how it goes. But largely on the market as well, 100 points higher. So Century early this morning. Let's see whether we can build on to those gains. Back to you.
Thank you very much for that. And, you know, Sonia, since Reliance has broken tradition and coming out with numbers on Monday, let's hope they advance the timing and, you know, come out with their numbers soon after markets close. But, you know, in the large cap space, it's HDFC Life which catches your attention. It's a gain of more than 2%. One, numbers are expected today. And two, there is a city upgrade on HDFC Life to a buy. Target price 720. They say the stock has underperformed peers in the last 1 year. And any revival in growth at HDFC Bank will aid HDFC Life. But numbers will be out today, so the street will watch that very closely. Power Grid is another big mover on the back of the Goldman Sachs note, 3% gain, 3.5% in fact. On Power Grid, they've pegged the target price at 350, and the top nifty gainer right now is BPCL. In fact, there is buying across the oil marketing companies, so BPCL is higher. IOC has a gain of nearly 3%. Other than that, Jio Financial Services continues to see buying. Even on Tuesday's trade, it was up. Exide, a stock which has, I think, been running up for 9 consecutive days now. And in 9 days, the stock is up 50%, another 4%. Vodafone Idea sees buying. The FPO opens today for retail shareholders, 13.4. IIFL has upgraded Vodafone Idea to an ad rating, target price 14. So inching up towards that target price. But Vodafone Idea is seeing some buying. Talbros has got a 1,000 crore contract win from a large European OEM. So Talbros is also a stock which is, looking up a fair bit. On the way down, it's Zomato, which is a bit subdued. It comes up on the radar because of the kind of volumes it's seen, but it's had a fantastic run.
All right. So it's a good start as expected, and we were talking about this in the morning. 100 plus points, so is what we have. So 22,251. Now you got to hold it, right? You got a good start, and straight off the bat, it's looking very healthy. So we are the range. The gap area is 22,200 to about 22,500 roughly. That's basically the zone for resistance which we put out in the morning. So let's see if we start to get that effective resistance come through. Now, just a few other names, right? We were discussing with Deepan Jio Financial Services. It's the second largest volume-led gainer this morning with a 4.5% pop as things stand. And Exide is another one that we highlighted in the morning with Deepan, 4% higher once again. So the momentum there continues, 477. Angel, of course, as well, with large volumes as well. HPCL is up 4.5%. Stocks at about 490 on Hindustan Petroleum. The oil drop of 3% showing up here. You got Just Dial, which is up 9%. AG's Chemical, big mover on Tuesday. It starts with a 4% pop this morning as well. XCom is another one with an 8% pop. Again, Tuesday, Exicom saw a large move, so that follows up. Chennai Petro is up 4%, stocks at about 947. You got Piramal Pharma, Brigade Enterprises, high-tech gear. I think Vivek was telling us about high-tech a little earlier, but that one is also looking good. TRIL, Transformers and Rectifies, 5% Tuesday, 5% now. And of course, in the last six months, it's gone up, I think, 10x, basically. So it's a really large mover and a wealth creator in that sense. Sterlite Tech is coming up with a cut of 6%. It had a very sharp move over the last 4 or 5 days, and it's got very large volumes in it for this point in the day. Second largest volume-led loser. And there is ABB, which is down 2%. Crystal, which is the facilities management company, that is starting about 2% lower as well. So that's essentially, the long and short of what's moving right now in the market at this point. Sonia?
And, just wanted to mention that, mid-caps are actually surging, almost 1% rally, right? Yeah. I don't know if you're getting the sense, but I'm getting the sense that maybe the worst of that global pressure we saw in the last couple of days is settling now, because even crude has moved back down. And now market observers in the West feel that maybe the situation between Israel and Iran is not as precarious as was earlier expected. So it's cooled off a little bit and the market has sort of resumed that up move. But it may be too early to tell, but that seems like the case for now at least.
No, I mean, absolutely. And I think we'll take it as a day at a time, right? Because markets, of course, at this point, interpreting no news as good news on the Iran-Israel front. Nothing new incremental in that sense. And one hopes it stays that way. But 100-plus points on the Nifty, so it's a good bounce after about a 2.5–3% drop that we've had. I mean, falls have been in that sort of vicinity, January to March. The January high to the low in March that we saw, that was 3%, 3.5%. That's it. And the market moved right back up. We have Ashwini with us now. Ashwini Agarwal is our market master of the day, founder and partner, Demeter Advisors. Ashwini, good morning. Good to have you with us here. Thanks very much for your time. What's keeping you occupied in terms of thinking about things? And, how are you feeling about the market, Ashwini, near term?
So it's very interesting. You were just talking about the Mideast drama kind of not having much of an impact on the market. And I've been wondering, if you look at the last 4 weeks or so, we've had significant change in the outlook for interest rates, both globally as well as in India. We've had the Middle East go, from being a known problem to now somewhat of an unknown, unpredictable situation. You had energy, raw material prices go up a lot. You've had gold prices rally quite a lot, reflecting the uncertainty in the world. And if you look closer home at India, if you look at Nifty or the sensex, as if nothing was wrong. The market's kind of taken everything in its stride, not batting an eyelid. A minor 2 to 3% correction over the last month, and we seem to be back off to the races again. So this is a little bit befuddling for me. Valuations are rich. They're not inexpensive anymore, especially in large pockets of small and mid cap space, which has actually rallied even further over the last month or so. You have all traditional valuation measures, whether you look at market cap to money supply, whether you look at price earnings ratio, whether you look at divergence between small cap and large cap performance, everything telling you have to be cautious, and the market will have none of it in face of a lot of global uncertainty. So yes, it's interesting just watching, trying to figure out, what am I getting wrong? I continue to be a little bit cautious, expecting that there's more downside risk than upside risk at this point. But, I've been wrong. So that's how it is.
Well, a lot of us have been wrong, right? Nobody expected this kind of a rally in the last 12 to 18 months, to be honest, despite all the problems that were thrown at us. But Ashwini, the important part is how do you navigate this market now, right? Because if you map the last 1 year, everything that hasn't worked in the last 15 years has worked in the last 1 year, whether it's PSUs, defense, railways, who would have thought, right? Yes. PSU banks as well. Do you think this is the way forward? I mean, what are the sectoral preferences now for you over the next, say, 6 to 12 months?
So, Sonia, a great question. The way I think about markets and opportunity, especially on a bottom-up basis, is where do I see stock prices slightly dislocated versus long-term fundamentals? So if you look at, there are a whole bunch of underperformers out there, which has started to find some life back. Life insurance being an example across the sector, where, over the last 2 years, the stocks haven't done much. These are fundamentally very, very good businesses, and we are starting to see some life come back into them. Among the other large cap spaces, there are several finance companies which have underperformed over the last 1 year or so. And they're looking interesting from a valuation standpoint. Several consumer companies are also starting to look fairly reasonably priced, even though the outlook on consumer demand is still a little bit tepid. So I'm looking at these areas. I mean, agrochemicals is another space where the oversupply that you've had in the distribution chain over the last 2 years should probably fade sometime during this year, and stock prices are completely beaten down. So I wonder if that's another opportunity if one were to look 1 or 2 years out. And similarly, there are others. So the way I think about investing in a market like this, where I'm uncomfortable with the aggregate levels per se, and in several pockets, is look for areas where we've had some underperformance and where valuations are reasonable. That's one. And number two, which would be interesting, for many of your viewers, is to watch where your equity exposure is. So, I always say that, you should have your equity exposure in a band. Let's say you are in your 30 to 40 years, it should be maybe somewhere in the region of 60 to 80%. So this is probably a time you want to be closer to 60% than 80%. That's how I think about it as an active investor. But if you're a passive mutual fund investor and working through SIPs, do nothing would be my guess. So those are the kind of two fronts how I'm trying to play it.
And what about export-facing sectors like technology, pharma? Where do you stand on that?
So IT I'll come to in a bit. On the export front, I think the businesses are doing well from what I understand, from whatever I've spoken to. Whether it's pharmaceuticals, because generic pricing is reasonably supportive. You're not seeing the kind of year-on-year declines that you've seen over the last 3 years. Raw material prices are stable. They have started to rise off late, but at least in the March quarter numbers and probably even in the June quarter numbers, you'll see reasonable margins on that front. So you'll see both growth and margins. I think the only headwind there is potentially increase in shipping costs. So that would be a minor element, I would say, as a headwind, but I think I see a reasonable amount of tailwinds. Similarly, in several other export areas, I see transportation cost as a problem. A weaker INR also aids earnings to the extent that you are adding value in India, so that also helps. In IT services, I think I will wait for the results. I think the environment is still pretty choppy out there, and especially the mid cap and small cap space in IT services, valuations are very punchy. I like the large caps relatively as a safe place in an otherwise expensive market, following my theme that that stocks that have underperformed and where valuations are reasonable is probably a place to hide. So that's how I'm thinking about it.
Okay, got it. I wanted your thoughts also on, a couple of these spaces like staples, for example, right? Dabur, HUL, Marico. Many of these stocks are trading at around 52-week lows. Valuations are quite suppressed at the moment. At some point, do you think it becomes attractive for long-term investors, and would you be a buyer now?
Yes, I think so. These are businesses that have a long runway for growth in a country like India, where I think 40-50% of the population is still very, very far away from consuming a lot of products that seem like everyday conveniences to you and I. So I think there's a long runway for growth. Valuations are reasonable now with the stock prices having come off. Raw material price environment is reasonably benign. Demand continues to be weak. That's a headwind, but I think that's priced in. So, if you were to buy it with a 3 to 5 year perspective, you'll probably make something like a 15% compounded annual return is my guess, which is not bad, for consumer companies. So yes, I think the consumer companies is on the staple side is a place to look for value.
But since you're looking for, does that fit into the sort of look for underperformers, right? You use the phrase to hide. I mean, is that in terms of actual returns, and if you compare what they've done against other sectors, sure, but valuations are still there. I mean, they've not corrected at all.
Look, Prashant, they have corrected in a relative sense. I mean, they were like, whatever, 3x, 4x, the median valuations for the market, and now they are probably at 2x. These are very, very good businesses in terms of their cash flow profile. And you will always find them trading at a premium to the market. So you had a reasonable amount of correction. I don't know if this is going to be a repeat of the 2000 to 2008 cycle, where for 7 or 8 years consumer staple stocks did nothing. I mean, that's something that's a question that keeps coming back to me when I think about it. But my sense is that on a relative basis, the risk reward ratio is evenly balanced. I mean, you'll probably make, as I said, mid-teens returns if you were to buy them here. Which is, which may not be very exciting for a lot of investors, but I think, where the market is positioned today, I think it's a very handsome return. So, and you might have to wait for a year or so for those returns to start accruing, given that consumer demand is still weak.
All right. A final question to you before we let you go, Ashwini. There is one narrative in the market which believes that because of the way China valuations are trading and the rally that India has seen, some of the money now will move out of India and into China. Are you on that in that camp as well? And from a global perspective, right, do you think the money will continue to flow into India, or is the story going to change?
I think it's going to be very investor dependent. There are investors who are value investors and who are sensitive to valuation differentials between the two countries of India and China. And I think there are investors who are saying that, look, we are in here for the long haul. And over the next 10 years, if we make, whatever, 14, 15% type of IRR in INR terms, and we give up 3% or so on currency, we are still fine. So you have both investors that make up the investor cohort. So I think for the latter, India will continue to be a place to stay. And I think for the former, there might be some opportunity to take some money off the table in India and put it to work elsewhere in the world, including China. So I think it's going to be a mixed bag. But yeah, I do think that, at the margin, if anybody is valuation sensitive, I mean, they'd be really scratching their heads and wondering what to do about India, especially when China looks so attractive from a valuation perspective.
Ashwini, we'll leave the conversation here for now. Thank you very much for joining in. Let's invite the first corporate on the show now. Sunita Reddy, MD of Apollo Hospitals, is with us. Sunita, first, a big congratulations. You've been named in the inaugural list of CNBC's change makers, women who've transformed business. They are women who've defied the odds, innovated and thrived in a volatile business landscape. So congratulations. Sunita, the question is that the volatility is probably, the challenges are going to continue. Where are we on the standardized rates for hospitals? Have discussions begun with stakeholders, or is this something which is going to take place perhaps post-elections?
I believe it will take place post-elections. But all of us, we have already created standardized package within the industry. Our job now is to work with the government, as we have done during COVID, to really sensitize people who are looking at these rates about the true cost of healthcare and why quality is important, and therefore why we cannot make compromises. So clearly it is a discussion that will happen post-elections.
Sunita, hi, good morning, and congratulations from all of us here again. Prashant this side. I was talking to somebody and they were saying that the government of Maharashtra tried something like this in 2021. They tried to regulate prices for non-COVID patients, and the courts actually ruled in favor of healthcare providers. Does that also kind of give you comfort, you and the industry comfort, that there is a precedent for something like this, or this is different?
No, there is a precedent for something like this. And I think the big question is really, can the country not afford, should the country not, continue to support the healthcare industry because we definitely need to create additional infrastructure. It's not just incremental infrastructure, but a huge, an investment at least 100,000 new beds just to prepare for the NCDs that could impact the country, in terms of spends of $4 trillion. But beyond that, should another pandemic come, will this country be prepared to treat it without investment in healthcare, and that through the private sector supporting what the government has done? So clearly it is working with the government that we need to provide quality healthcare for our country.
Just one follow-up to that, Sunita. In the interim, you said discussions, etc., will start post-elections. But in the interim, and business goes on, but on prices, are price increases, if they are necessary, because different hospitals follow different cycles, are they a little bit on the back foot, not on hold maybe, but are you kind of cognizant, are you taking lesser than what you would have normally taken because of where this is at?
So prices are also linked to inflation. Inflation last year was at 5% for healthcare inputs. So we have absorbed that 5%, and inflation has come down this year when you compare it to the previous year of 22-23 and 23-24 cycle. So I believe that tariff increases will be minimum rather than what happened in the previous year.
Okay. But would this potential negotiations, because I mean that is, I'm assuming, one component, right? Inflation, WPI. But will these sort of negotiations, consultations, whatever, which are yet to happen, will this kind of put a lid? If costs were to go up, you'll not be able to take the requisite increases, or you think that will not be a factor? I'm talking about till the point that this is resolved one way or the other.
You're right. I think that we've already taken a slight tariff increase to really compensate for cost of inputs. But looking at this current dialogue, we've already done the packages that are ready for the government, which keeps our margin intact. But the focus is on cutting some of our costs, which we believe that with this, we can improve our margins by 100 basis points. So this effort will continue, and therefore margin expansion is something that you can continue to expect from us.
Okay. Sunita, hi, good morning. This is Sonia here. I had a couple of questions on, the game plan going forward for Apollo Hospitals, because many of your peers are now going very aggressively with acquisitions. So I want to understand, you also have some capex plans on board. Tell us a little bit about that. Over the next 12 to 18 months, how much of it will be, through the inorganic route? What is the amount of money that you have kept aside or earmarked for acquisitions?
So we've already done 2 acquisitions, which we'll open in 2025. One in Calcutta, where we acquired a 200-bed hospital. We are actually making it a 300-bed hospital. So this will come on stream in 2025. We have a hospital in Hyderabad, which will come on stream by the end of 2025. And again, this is another 300 beds. We have our Gurgaon facility, which is slated for 2025. That is also an acquisition. So it is a blend of both acquisitions and greenfield that will give us 2,000 beds in the next 30 months. And this will really continue to grow our network with a strong presence in metro cities.
Okay. So earlier you had outlined the capex of around 350 crores over the next 3 years. Is this something that you're sticking to, or do you think you would want to build onto that as you expand further?
So 3,000 crores is what we said, and we are committed
3,000 crores. Okay.
3,000 crores, but we always are looking out for acquisitions, and there are some acquisitions. Of course, we have also made Pune, which is an acquisition of 300 beds in Pune, Royal Mador Hospital. So we continue to have both options, and I think that you can expect to see significant growth in number of beds happen in the next 3 years. The openings will be calibrated, so we don't have a bulk of 2,000 at one time. Every year we will be opening out 700 beds for the next 5 years.
So this growth guidance that you had given, right, of a 15% growth in FY25, Is that intact, and or would you want to sort of tweak that?
That is intact. Let me be careful and say that definitely 15%. Over and above that, when the new facilities become fully operational, we will see growth in excess of 15%.
Okay.
Just to sort of tie up that point on acquisitions, we have, we know that, a large owner in, financial investor in HealthCo Global wants to get out. And I think we've discussed this in the past as well. But has there been any, has that sort of come to you? We got a seller and they're trying to find a buyer. So just trying to get a sense from you, ma'am.
Yes, we look at all opportunities. We have consolidated our presence in the oncology space where HealthCo Global is a player. I believe our offerings are, in a sense, that they are all India. It's a different way that we are, focused on oncology. If you look at revenues and patients treated, currently we are the largest. So we continue to look at these acquisitions as long as they are accretive to the company and enhance our offerings.
And that's a very attractive segment in terms of margins, etc. as well for hospitals. But is that a no, ma'am, as far as HealthCo Global is concerned? That you're going to do your own thing in that segment and you built it out nicely. So this is not...
Built it out nicely. Our clinical outcomes are very, very good. So I think it's a different way of operating.
Okay. So, I just wanted a little bit of indication on how Apollo HealthCo is going to go. I know we ask you this every single time, but the GMV, right, that you've seen in 9 months of this year has gone up. It's almost doubled year on year. So what kind of growth are you targeting for Apollo HealthCo?
Well, I think we had said by the end of next year, 1 billion in revenue in terms of 1 billion in GMV. So we are on track to do that. But I think the most important thing is that, the operating losses reduced significantly and it continues to improve quarter on quarter. So and they delivered their EBITDA neutral last quarter. So, the future is looking very good.
So what are the number of registered users now on the platform, and what is the kind of growth that you are hoping to see over the next 12 to 18 months?
Over 30 million registered users.
Okay.
So we're on track.
And
sorry.
No, I know. I just want to complete that loop. You had said earlier that some investors are interested. So any plans in terms of fundraising that you'd want to perhaps conclude by this calendar year? There's still a lot more time to go. So anything you'd want to say on that?
I believe that we continue to look at investors, those that will add value. It's a strategic value, which is good for the company and good for the shareholders and enables growth. These are the three things that are extremely important. And I've always maintained at the right time, appropriate time, we will be talking to you.
Ma'am, just one last point on international patients. How is that sort of segment done in the quarter gone by?
It's done well. I believe that especially in the north with connectivity, we've done extremely well in the north, Delhi, Bombay, and of course, southern Chennai has improved. So we're really expanding our reach into international markets with connectivity in place.
Okay, all right. Thank you very much for joining us. It's a pleasure, as always, having you with us here on CNBC-TV18. Good luck with business and good speaking with you here, as always. Well, just take a quick look at what the market's doing. It's come off. We were wondering, it was a good start. We were wondering whether, getting straight into that resistance zone is going to have any effect. Looks like it's had. So we're about 50-60 points off the day's highest point, but still around 22,200 is where we are trading at. Just a quick look at, I was talking about this with Deepan earlier, sorry, not Deepan, Mitesh earlier. Look at VATech Vabag. Had a 16% move on Tuesday, and it's basically broken out into, not quite, I think 10 rupees away from its 2015 all-time high. So I think the high, let me just pull this up, I think was about 972, and we're at about 966 right now. So that's a very large move once again with a 5% pop on large volumes as well. But Rima, the big story, of course, is Vodafone Idea, the FPO.
Oh, absolutely. So first, let me just tell you about the anchor investors. They put in 5,400 crore and the names include GQG, Fidelity, Morgan Stanley. GQG has put in the most at 1,348 crore. Fidelity has put in 774 crore, and even domestic funds like Motilal Oswal Midcap Fund has put in 500 crore rupees in this particular FPO. The FPO has opened today and it closes on the 22nd of April. The question is, what next? With this money, the company is hopeful about closing the bank funding very soon, which is to the tune of 25,000 crore rupees. So totally, the company will be armed with 45,000 crore of capital, which the company has said is growth capital. And this money should suffice them for their capex for the next 3 years. The money raised will be used to augment their 4G coverage and capacity and also start their 5G rollout. The company in the interview has said that, not being present in 4G has been the reason why they're losing subscribers. So once they begin expanding their 4G coverage, they are hopeful that market share of the company will go up. On 5G, their plan is to cover 40% of their revenue base in the next 2 to 2.5 years. On ARPUs, the company did indicate that the street can absorb a tariff hike, which is similar to what we've seen in the past. So that is close to about 20%. He believes it can be absorbed by the market without any major implications. On government support, when we ask them, because the big fear in the market is what happens post-September 2025 when the 4-year moratorium comes to an end and the company has to pay the government 29,000 crore rupees in H2 of FY26 and 40,000 crore plus from FY27 to 30, for the next 4 years starting FY27. Will the company be able to generate enough cash flows to meet those payments? Because if they can't, then the government dues, the debt may have to be converted into equity. The company said that we will need government support for some more time. The financial plan, the telecom plan, which was announced, the rescue package, does allow that the government can convert some of their installments into equity, and he believes that there is a chance that the government will need to convert those liabilities into equities, which means there will be some dilution. But according to him, dilution is not such a bad thing. IFL today has upgraded the stock to an ad with a target price of 14. They recommend subscribing to the FPO. They've also upgraded Industars to a target price of 375. The company will benefit from Vodafone Idea's financial position and the 5G rollout. For Bharti, the target price now stands at 1379. And the two key reasons for upgrading the entire sector, increasing the target price. One, they see 2 tariff hikes in the next 3 years of 15 to 20%. And 2, they believe there is some chance of a reduction in the AGR liability, which will be positive for Vodafone Idea and Bharti. So that could be the government support, which the company may be hoping for. But we have got Deven Choksi now joining in on the show. Deven, would you recommend, retail shareholders participating in the FPO? And is it just for arbitrage, buy now and flip perhaps in the next few days? Or do you think over the longer term, this company has the might to take on Bharti and Jio?
Yeah, Rima, good morning. Well, on one side, I think the business possibilities are many. The growth prospects, given the kind of demography that we have, is simply, I think, assuming that most of the players will have relatively larger amount of penetration into the 4G and 5G spectrum that they have implemented through the, I think, larger population that we have. So that possibility is not ruled out. And as such, I think the business is demanding huge amount of capital investment. Likes of Jio have suggested that I think the bulk of capital investment has to be front-ended. And then subsequently, I think you have to use the money for the purpose of converting the customers into the newer technology platforms. So they have been pretty successful with that, and they have created a large size book. Here, the Vodafone Idea, per se, I think is basically moving last in this particular space. Maybe they have some advantage at the same time from learning from others, but at the same time, I guess I think the investing smaller money in creating the presence may not be sufficient, may not be enough. Maybe I think at this point of time, this 45,000 crore worth of investment is possibly giving them some hope, some lifeline. After investing in 2022, I think now again in 2024, this money Maybe this process will continue for some more time. I think that they will have to take some more money. But I believe that I think the capital investment program will have to be continued going forward. So given the possibility that on one side, the business acceleration demands huge amount of capital investment, and so the profit will take little longer time and shareholders return also will take little longer time. On the other side, market momentum remains absolutely very strong. So this momentum is suggesting that the downside risk in the stock will be limited. So those who are traders, those who want to flip the stock, I think they will not be disappointed. That is what my understanding is. Those who are long-term investors, they have to really stay long-term in this particular company beyond 5 years.
But since you're saying that, the downside may be limited, but in the upside, there will be a lot of patience that's needed from long-term investors. Do you think the opportunity cost is better with some of the other, telecom companies, maybe a Bharti, a Reliance, which have already rallied quite a bit? What's your view here?
Yes, Sonia, I think that is important because I think the way in which the technology platforms are changing, the way in which I think the computing demand, I think, is increasing, the way in which adoption of AI is taking place. I think the technology 5G will have to be soon upgraded to 6G going forward. And if that is the situation, then probably I think the people who are not catching up even today with 5G will find it, I think, extremely hard, or the struggle would be extremely high as far as I think their ability to adapt to the newer platform of technology. So maybe one can clearly say that I think go with clarity, go with the surety as far as I think the business outlook is concerned. The likes of Geo, they are putting in significant amount of investment in building the use cases in different industry verticals. And to my mind, I think it makes choice irreversible as far as I think the customer is concerned to adapt to the platform, Geo platform, or the 5G for that matter, because of the use cases that they are building in. I think your entire life would be dependent on those kind of use cases. So to my mind, I think it would be better to stay with the clarity where I think you are very sure. Or there in Geo's case, 1,20,000 crore revenue book is established, 60,000 crore worth of EBITDA is established on a yearly basis, and it is growing at the rate of 20%. So every 4 years, I think the balance sheet is getting doubled. I would rather prefer to, I think, stay with clarity. That would be my take on the subject.
Indus Stars, by the way, is up nearly 5.5%, taking its year-to-date rally to 76%. Devin, Indus Stars is a clear winner, right? With these developments with Vodafone Idea is spending on capex, which means more money goes into the hands of Indus Stars, more business for Indus Stars, and plus there is a chance that the old receivables will now get covered. But the question is, Indus Stars is already at 350. It's up 155% in the last 1 year. So from here on, is there upside?
So the market has actually factored in the possibility of they receiving the money through this infusion of funds by the Vodafone Idea, which categorically the management says that I think it is not going to be the case. The immediate priority is going to be spending towards a capex program, both in 4G as well as in 5G. In fact, more in 4G and little less in 5G. So to a greater extent, I think every other creditor will have to wait till the time the bank creditor is getting paid off. In my viewpoint, I think at this point of time, I'm not counting on immediate possibility of Indus Towers getting a significant chunk of money, though they have 17% of the program, I think, from this equity issue, where I think they would like to possibly retire some part of the creditors also. But immediately, I think that is not something which we are counting on. Maybe the stock has rallied ahead of its time. That is what I would like to say.
Devin, stay with us. Mahesh Uppal is also with us, director at Comfirst India. Mahesh, you've seen the sector a long time. Thank you very much for joining us. Prashant this side. Good to speak with you again. Because there are so many moving parts here for Vodafone Idea to work as an investment idea. The AGR due, something needs to happen there. There is tariff increases which need to happen. I mean, generally the overall external environment needs to be pretty supportive. Do you reckon all of this could sort of align in the right way with, of course, the government doing a fair bit of heavy lifting as well? They are, of course, the single largest shareholder, one of the largest shareholders with over 30% stake now.
Yeah, no, I do believe that something will have to be worked out so as for Vodafone to kind of make it or survive. Because I think the government itself has made several statements over the years saying that it is committed to a more competitive market. It's also true that Vodafone, despite having a huge AGR liability, for which it can partly blame itself, but having said that, there is no doubt that Vodafone itself is a fairly competitive player in the marketplace. There is little evidence that Vodafone's network is poor, or that the network, the Vodafone's quality of subscribers in terms of revenues are particularly a challenge. It is true that they have been losing a lot of market share. Obviously, the environment and the the kind of press and some justified press that it is getting, its difficulties are obviously reflecting in the marketplace. But unlike BSNL, for example, Vodafone is a good network. It pretty much measures up to most of its competitors, despite the fact that it doesn't have a 5G network. And also, remember that for a company to have roughly about 18 to 20 crore customers is not a small thing, and especially if it's across the country. I mean, this is the size of several networks in Europe. So I would not think that Vodafone is totally out of trouble, but I'm more optimistic that it will survive.
Okay, it will survive, but will it thrive? Can its market share go up? We've seen the market share fall, but do you expect the market share to rise? Execution was never a problem for Vodafone Idea. Capital was a constraint. And now that they've got the capital and they're investing it all in growth, with this enhanced 4G coverage, capacity expansion, and the beginning of 5G rollout, do you see market share gains coming for Vodafone Idea?
Yes, I do. I mean, how significant there will be, time will tell. But I do. I mean, given what you're saying, and which I also agree with, the execution has not been a problem for them. It is really capital. And now that they are likely to get some more investment, get some more funds, I would imagine that they are well placed to put it to good use and to try and recoup some of the losses that they have had in the market share space.
Mr. Uppal, thank you very much for joining in. We thank Deven as well for his time and insights on this particular issue. We need to get into a break, but as we do that, here is a quick programming update. Join us live today, 5:30 p.m. onwards for CNBC TV 18's Future Female Forward, the Leadership Circle, a transformative platform where women leaders come together to connect, express and evolve. The circle of trailblazing women leaders from diverse fields will venture beyond the traditional discourse during the course of the discussion. This leadership circle is not just about business strategies and professional accolades. It's about delving into the depths of personal journeys that these women have taken.
All right, it's time for our special segment, Quarter Se Quarter Tak. We bring you the earnings expectations from each sector. Today, it's all about banking. Abhishek is here to tell us what to expect. Abhishek, over to you.
Well, in Q4 FY24 for the banking sector, as on 22nd March 2024, the loan growth was around 20.1% YOY and around 3% on a sequential basis, that is quarter on quarter. So the low-cost deposit ratio has been declining for the past few quarters, and you can expect that trend to continue on a downward trend. So CASA ratio will continue to decline even in Q4 FY24 for many players. Net interest margin will decline for many players as cost of funds have risen or will rise for them in the Q4 quarter. So there can be operating profit growth rate slowdown if you check on a YY basis, largely due to decline in net interest margin and also lower trading gains that they will have this time around. Now, credit cost will remain on the lower side for the sector, thereby that can actually aid the bottom line and the return ratios. Earnings, however, will be under pressure. They may see decline in earnings for some of the lenders. Banking sector is witnessing the best asset quality in over a decade and it will continue to remain in a sweet spot. Expect the slippages trend to be on the downwards trend. However, you can also expect recovery and upgrades to be on the lower side as well in this quarter. So the key highlights will be the focus on deposit mobilization as it has actually lacked the loan growth over the last few quarters. Hence, lenders' outlook with respect to focusing on deposit growth or slowing down loan growth will be seen very closely. Now, some of the key estimates from Kotak Securities are for SBI, they expect NII to be a decline of 0.5% YOY and up about 1% on a sequential basis. They expect net profit of SBI to be around 13,150 odd crores, down 21% YOY and up about 43.6% sequentially. For Bank of Baroda, Kotak Securities estimates NII to decline 2.2% YOY but be up about 1.5% quarter on quarter. However, for profits, they are expecting a decline of 7.2% YOY and about 3.2% sequentially. For HDFC Bank, taken only sequentially because of the merger of HDFC Limited, the NII estimate of Kotak Securities is up 3.5% quarter on quarter and net profit to be up 22.3% quarter on quarter, largely aided by the other income as well. ICICI Bank, the NII is expected to be up about 3.7% YOY but a decline of 1.9% quarter on quarter, while net profit as per Kotak Securities is estimated to be up 4.6% YOY and a decline of more than 7% quarter on quarter. For Axis Bank, Kotak Securities estimates NII to be up about 8.9% YOY and about 2% sequentially. They are expecting the net profit of Axis Bank to decline by 1.7% YOY but be up about 0.7% sequentially. Back to you.
Okay, thanks a lot for that. Nitin Agarwal is joining in now. He's the head of the BFSI Research Institutional Equities at Motilal Oswal Financial Services. Nitin, hi, welcome to the show. You heard Abhishek out, he listed very beautifully what the expectations are from the sector. But you tell us from the entire pocket, which are the companies that you're most bullish on this time? What are the growth expectations? And where would you be cautious now?
Yeah, hi. So yes, certainly overall numbers are going to see moderation. That's a process that's been going on for over a year. And so this quarter, we are looking at a 6% earning growth, ex of HDFC Bank for private banks, around 12-13% for PSUs. And this compares to when the year started, these numbers are 40% growth for private banks and over 100% growth for PSUs. So the moderation is continuing, and probably for the coming quarters, this trend will continue. And in terms of banks, wherein we think the steadiness will continue the numbers, we like ICICI Bank, wherein we are looking at a 16-17% YOY earnings growth, and SBI, wherein we are projecting a 16,000 crore PAT. Last quarter was a little depressed because of the pension and the wage provisions that the bank had to take. And while some part of it is still to come through, but Q4 is seasonally a strong quarter. So wherein we think the numbers will look much better on a sequential basis. And amongst other private banks, we like IndusInd Bank, wherein we are expecting stable margins. And business update is already out for most banks, including IndusInd. And we have a very steady growth on both the loans and deposits. And that, backed by some improvement in credit cost, will enable a 18% YOY earnings growth. HDFC Bank, I will say, is sorry.
Yeah,
is a,
sorry, please come.
HDFC Bank is where we are expecting a 15,500 crore sort of PAT, but we are not putting out any number on Credila and being a non-core gain. But otherwise, the reported PAT, of course, will look a lot higher than what we are putting up.
Okay, now those are individual sort of banks, but that's earnings in the bag already, right? What about sort of making adjustments to future earnings? Net interest margins, for example. Now, the big theme as we started this year was rate cuts, both in the US and from the RBI as well. That is now looking like a distant kind of event, maybe sometime in September, October this year, if that. Even here from the RBI. Do you think that warrants a little bit of adjustment on the upside on NIMs across banks. Have you done that, Nitin?
Yeah. So, no, we haven't really changed numbers in the last couple of months. Of course, we did some revisions at the time of preview, but this entire expectation about the rate cycle getting pushed back is something that we all need to recalibrate to. And our own view internally is that we will not see a rate cut until at least the end of this calendar year. And which is where, but in a way, I think it's not so negative as an outlook for the overall banks, because it gives time to banks to readjust their overall funding cost. Because any upfronted moderation or reduction in rate cycle would have led to a reduction in the loan yields, and that would have further impacted margins. But now banks can recalibrate these adjustments better, and which is where the earnings will be a little more even. Or we already had a very uneven year in terms of quarterly progression, as I talked about in FY24.
Nitin, the big concern in Q3 numbers was the NIM contraction. Now, you believe in Q4 NIM contraction will ease. What is the reason for that? And what is the expectation on margins going into the next 6 to 9 months?
Yeah. So, while we still expect the NIMs to moderate, but it's the pace of moderation that will ease in Q4. And already, if you look at for some banks, say for ICICI, which has had double-digit contractions and margins in the prior quarters, we are expecting a single-digit decline now. So it's essentially the repricing of deposits, which is getting largely completed. And there has not been any further increase in the deposit rates in the recent months by most banks. And this stability in the repo, which is also going on for over a year, is leading to a stability, therefore, in the lending yields also. So which is where we believe that the margins for the near term, until the rate cycle starts to turn, have stabilized. While there is still some downside risk, but that is very marginal when you look at in context to how the decline has been over the year. But our view as such for the coming year in FY25 is that margins will still moderate a bit more.
Some more moderation. And on growth, you started off by saying the private sector banks will report a 6% growth, which was 40% at the beginning of the year, and PSUs will report a 12-13%, which was more than 100% at the start of the year. Do you think growth rates will continue to moderate? What is your own expectation for FY25 from current levels?
Yes, I think growth rates, yes, will still moderate because the margins as such overall are still a little soft. And even on the loan growth side, we had a 16% growth in FY23. The current year is also going around the same number. And we expect even the loan growth to moderate to 13.5% to 14% range in FY25. So for these reasons, we expect the overall loan growth to moderate. And we are looking at nearly 14% growth for private banks and around 17% growth for PSU banks in FY25. So that both these numbers are relatively lower versus what we had in FY24.
Okay, got it. Finally, let's wrap this up with the NBFC space. What is your thought over there, and what are the stocks that you're bullish on? What is the kind of growth that you're looking at?
Yeah. So overall, NBFCs, I think this postponement of the rate cuts cycle that we were all expecting will going to relatively have higher cost of funds overall. So the expectation of a decline is not going to happen as much in a hurry. But overall loan growth is still remains good, and asset quality cycle still sees positive trending overall for the sector, and which is where we think the earnings growth will still be steady for the NBFC space as such. And therein we like Shriram Finance, Chola amongst the top ideas. PNB Housing is another team that we like.
All right, we will leave it at that, Nitin. Thanks a lot for joining and appreciate your time here on CNBC-TV18. Well, let's move on now. Mitesh Thakkar is joining in to tell us about the market, which, by the way, is not bad. It's a 60-point rally that we're seeing on the index. At least the selling pressure we've seen in the last 3 days has been arrested for now. The market has resumed its uptrend. I mean, it may be too soon to say that, but at least there's green on the screen for now. Mitesh, how are you feeling about the market? Do you think it can build on to its gains from today? And are you a little more optimistic than you were a couple of days ago?
I'm not, honestly, but I think this is a market, which has found its bottom or at least made a temporary low, given the fact that I talked about this data of, PCR being extremely oversold. The put call ratio was 0.63 in the morning, and that's suggesting that at least a temporary bottom can be made. So I still believe that the overall structure isn't turning positive, but I think we might not see the markets, continuous declining more and get into a sideways kind of consolidation. So initial belief is that 21,950 and then 22,300, 350 could be the range which the markets could do for next few days. Having said that, I have two buy calls right now. I think HDFC AMC is looking very good to me. It's, after a few days of correction, is showing good pattern on the upside. So buy here with a stop at 37.65, maybe just 5 points below that, and look for a target of around 3,900. And the other one is SBI Cards, which is showing patterns of reversal from lower end. So here, buy with a stop below today's low. So 725 can be a stop loss, and look for a target of 760.
All right. Mitesh, thanks very much for those ideas. We're up 40 points on the Nifty with about an hour of trading behind us. We'll take a quick commercial break here. Manisha puts the focus on commodities on the other side. Stay tuned. That's coming up.
So shifting focus to the commodity markets, Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, for the day today, I'm looking at metals as a sector because we're looking at stronger gains continuing for most of this sector, whether it's ferrous or the non-ferrous metals. I'll start with copper because the prices are still holding at around 14-month highs onto this one. And there are reports that how Antofagasta could be looking at first quarter copper output down by 11% on an year-on-year basis. And going forward as well, the numbers could stay on the weaker side in sense of production. Inventories as well have been declining, and that has been keeping the markets in support there. If you look at the prices itself, we've seen copper prices gain up by 12% in this year until now. Last year wasn't so great. If you look at the fundamentals, they have been on the positive side. The demand seems to be improving. The inventories are declining. We're looking at higher premiums from Japan, and also the smelters in China are cutting production. And that has led to a very strong bull run by the money managers as well. So if you look at the hedge funds, well, they are holding the longest positions since 2018 at around 84,000 contracts, which is equivalent to over 2 million tons of holdings in sense of copper. This is inside of the longs. This is overall hedge funds there. If you look at the exchange-wise breakup here as well, so CME copper longs are at 119,000 contracts, which is the highest since Jan 2018 as well. And then comes LME, where we are holding very strong positions as well. And when you look at the daily averages for the month of March on an year-on-year basis, while CME has seen averages increase by 18%, on LME as well, we've seen the averages increase by 21% there. The open interest also is surged from 192,000 contracts to 299,000 contracts. So the fundamentals have been on the stronger side, and the smart money seems to be really moving on in case of copper sales. So the best of money really has moved into this one metal there. Also, when you look at the aluminum prices, we're trading at a 22-month highs onto this one. The Western sanctions is one part of it. The Guinea supply concerns has been another. And then Yunnan production has been declining because of dry season, also is keeping aluminum prices as an outperformer there. This is what we've done on a week-on-week basis in case of the metal prices, where you have seen nearly 3% of gains come in for copper in the last 6 trading sessions, 1 to 5.5% of gains in most of these metal prices there. And the outperformance comes in from steel, which has gained up by 8% in the matter of last 1 week itself.
Okay, Manisha, thanks very much for that. So that's commodities and metals specifically in focus. Well, let's focus on some specific stocks on the move. Power Grid is the first one that we have on our radar. Vivek is going to explain. Vivek.
Well, that's right. Some positive news flow coming as well, given the fact that there has been multiple projects that have come up for bidding under transmission. The company again, informed the exchanges day for yesterday that it had 3 important projects. So the first project, number 1, it emerged as the lowest bidder under the TBC, which is the tariff-based competitive bidding. So this is an open bidding platform where the company has been emerged as the lowest bidder for 3 projects. And all of these projects will be done on a BOOT basis, which is the build, own, operate and transfer. Which are the projects? It has one project is for transmission system in Rajasthan SEZ, both Part C as well as Part E. The transmission system will be developed by Power Grid. The second project is evacuation of power. This is renewable energy from Khavda in Gujarat. Now, along with that, remember, earlier today we also highlighted a very important note that had come in from Goldman Sachs on the entire power transmission space. Their top pick in India's power transmission remains Power Grid. They have a buy rating on the stock. They say that India's largest transmission asset developer is their top pick. They see Power Grid as a player on the grid capex super cycle with a very large and strong balance sheet. They say that the company has the ability to fund almost 30% of India's capex requirement as far as transmission is concerned between FY24 to FY32. And they also say that the company has structural funding advantages and consistency always is there, given the fact that the core earnings trajectory is regulated and thereby it can be predicted.
All right, thanks a lot for that. Let's slip into a quick break. Up next, we'll be joined by Amrita Sen, the founder and director of research of Energy Aspects, to discuss the impact of geopolitical tensions on global markets. Stay tuned.
Welcome back, and Amrita Sen is founder and director of research at Energy Aspects, and she joins us live here at CNBC-TV18. Amrita, hi, thank you so much for joining us. You know, the crude oil prices have been quite jittery. The latest, of course, has been a 3% decline in the overnight markets. But the latest trigger with Iran, Israel, the kind of profit-taking that we've seen, and the fact that it has been a very strong, volatile year for the crude oil prices. How would you look at 90, which really seems to be a pivot point right now?
I think the biggest driver of crude oil prices this year has actually been fundamentals, right? We've seen a much stronger fundamental picture since the start of the year than anybody had expected. And in fact, if anything, prices have been lagging the physical prices that, you know, refiners would pay usually. And we've now actually seen a pickup in that. And then, of course, the latest is Israel-Iran, as you mentioned, and that has, you know, definitely helped Brent prices above $90. We maintain our view that we do not expect any supply disruption or any significant supply disruption for oil and gas from these geopolitical tensions. We also think, in general, neither side has an incentive to escalate it to the point of attacks, right, on either side, because I think that would be a lose-lose. But that doesn't mean that the tensions are going to go away anytime soon. And we also do believe the market will remain fairly choppy. We are not in the camp that expects significant upside due to the geopolitical tensions. It's more that it provides a bit of a floor, especially given fundamentals are already strong. So Brent should trade around the $90 mark.
So while you do believe that the prices will stay around 90 for this quarter and the next as well, what's your sense? Because there are various reports suggesting 95 and beyond.
We've been calling for, and our price forecast was for $85 Brent for the full year, very much from the start of the year. In fact, late last year, when most people, I'm sure you talk to, have had $60, $70 price forecast view, and we're not changing that yet. We've been calling for a $90, $95 Brent in Q3 in the summer. It's come a little bit earlier. So yes, there's potentially a little bit of upside, but the annual average should still very much be, let's call it 80s. Maybe it dips into the early 90s. Now, look, if the escalation were to get out of hand, could we see a triple-digit print? Yes, we could, but that's not our base case.
Amrita, there are various reports as well suggesting that a deficit is what we should be preparing ourselves for this quarter and the next, to the tune of 0.5 to 1 million barrels per day as well.
Well, for Q2, we have a very small draw, and we always have had that, but it's very June heavy. April, May are bills, which is why our core view has been we should be pulling back a little bit right now before we actually rally. The key thing for this oil market is what happens in the summer. It's Q3. Our balances are talking about 2.5, 2.6 million barrels per day of draws. This is an enormous draw, and stocks everywhere are actually quite low. So I think that's the challenge, and that's what the market is solving for. If you think about it, if we don't have a lot of inventories and we are heading into peak summer draws of over 2 million barrels per day, and our balances assume OPEC will bring back a little bit of production over the summer. in reality, they may not actually choose to bring back production. Is $90 enough to solve that, right? Is $90 enough to bring OPEC barrels back? Is $90 enough to incentivize the US administration to do an SPR release? It's not. And if that's the case, then prices ultimately will go even higher because the deficit is just too big.
Amrita, as you mentioned about the US and the SPDR draws as well, which we have seen immense, by the way, in last couple of years. How are you looking at the US elections and the point that nobody would really want crude oil prices turning to those 3-digit numbers?
Absolutely, which is why I just said, like, is $90 enough to elicit a response from them? We do think an SPR release is on the cards for this year. The US is probably going to draw down 30 million from their strategic reserves just to keep prices low. But that's probably not at 90, that's probably at $100, right? So we're still $10 away from that. But yeah, we do absolutely believe the US is going to turn a blind eye or continue to turn a blind eye towards Iran. Maybe they do not reimpose sanctions on Venezuela, which will actually benefit Indian refiners a lot. IOC, Reliance, they buy Venezuelan crude. And as of right now, the US needs to take a decision by the 18th, which is in 2 days, that whether they're going to reimpose some of the sanctions that they had lifted. And Indian buyers had actually stopped buying Venezuelan crude. But at $90 oil, maybe they don't bring that back. So look, they will do everything in their powers to make sure that prices don't go up too much. But at the end of the day, the fundamentals are strong enough that, prices are not going to go down too much either.
Amrita, also, what's your sense on the Indian demand? I mean, I know the Chinese demand and the data seems to be improving, but much of the marginal increase in demand growth is expected to come out of India.
Indian demand is very strong, for sure. I mean, it's a little bit mixed on the other oils, like your bitumens and your asphalt demands. It has also been very hot. Diesel demand hasn't been particularly strong of late. But again, I think the heat wave potentially is a part of that. I think overall and more structurally, we remain very constructive on the gasoline side. More people driving, better roads and infrastructure. And of course, with elections coming up, generally there's going to be a lot of support for demand because, again, there's just going to be more stimulus from the government. So robust demand of about 250,000 barrels per day, give or take, year-on-year growth, and this is about this is end user demand, gasoline, diesel, jet, and so on. And yeah, that should continue over the course of this year.
Amrita, there are various reports out there suggesting that the global aviation demand seems to be picking up, and those numbers are out, whether it's about Asia, US, or even Europe for that matter. What are the numbers that you're working with?
For globally, yes, jet is the biggest driver of global demand growth at about half of our 1.4 million barrels per day total demand growth. So more than 50% is going to come from jet because China's reopening is still ongoing from the airline side of things. Everything else is pretty much back to normal, but travel is still being eased, and therefore you are actually seeing better travel numbers. In fact, Q1 in China was a record high. But yeah, a lot of routes are now being added between China and Europe and US and rest of Asia. So that's going to be the key thing that drives global jet demand higher.
I just want to come back to the first answer that you said, that while there is lots happening, but we haven't really seen an impact on supplies. Would you say the same for Red Sea? And do you believe that the geopolitics, even as they continue to simmer on the side, wouldn't really impact so much as supplies?
Look, geopolitical tensions remain high, but equally none of them are really materializing in supply losses. The only one that is actually a potential threat to supply, and probably the biggest threat this year, is Ukraine-Russia. Ukraine has been launching attacks on Russian infrastructure and particularly refineries. Could they expand that to other infrastructure like ports and so on if they don't get the funding? And if that's the case, then there could be a lot of upside to both, oil products prices and crude oil prices. The Red Sea is more of a supply disruption. Sorry, it's not supply loss, but trade flow disruption, right? Now you just have to go around the Cape to reach Europe. So it increases the cost. It's inflationary, but it's not a supply loss. I think that's the difference between the two. And we expect that to continue.
All right. Amrita, final question. This is about macros, really, because there's a conversation about rate cuts and there's a lot of currency movement as well, with dollar index at a 5-month highs, and every other currency, whether it's Asia or the high-yielding currencies, have been trading at multi-month lows. What do you see an impact of all of that on global commodities?
Yeah, I think there is a bit of optimism around global demand, and that's because of these expectations of rate cuts. Our view also is that the Fed's going to cut rates, but I would just warned that if oil prices were to spike higher and this, inflation concerns come back, I think it'll be a lot harder for the Fed to cut 3 times as the market expects.
All right, Amrita, thank you so much for joining us. So, well, 90 to 95 and 100 not ruled out in case something really flares up there, but that's really not the best case scenario here. That's a wrap on Bazaar with all that conversation, but Chart Busters is coming up next. Stay tuned.